2023 is very likely going to be the year of recession.
We might skirt a recession, or if we do a recession, it'll be relatively light.
It's an open question of, will we have a recession? When will it be? How deep and long-lasting might it be?
If inflation is not on its way to 2%, the market will struggle.
Right now, the market is still being very overshadowed by the slowdown we anticipate.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning from New York City for our audience worldwide. This is Bloomberg Surveillance alongside Kailey Leinz. I'm Matt Miller. I was doing a little bit of my John Farrow impersonation there.
With two good mornings.
With the double good morning.
Excellent work.
John, Lisa, and Tom all on well-deserved vacation. Kailey Leinz and I are in for them this morning. Let's take a look at what's going on. First off, in the markets, we have gains across Europe this morning. So you would think everywhere else is going to be risk on, I should say, as well. Yep. In terms of what we see on futures, we do have a little bit of a rise, about 0.6% on the S&P Mini. So it does look like we could be on for a late, belated Santa Claus rally. I mean, we were up on Friday.
We were up on Friday, but we still had 3 consecutive weeks of losses on the S&P 500. So we'll see if we can eke out a gain on this final trading week of the year. China trying to have a hand in that overnight, releasing the last really remaining COVID zero curbs. They are now relaxing that quarantine requirement for inbound travelers. That'll start on January 8th. So basically reopening the second largest economy to the rest of the world. It has been shut off from for the last several years. And that really is what is feeding through into the commodities rally this morning.
Yeah, that's going to be for sure our top story. We're going to talk a lot about what's going on in China, how that's affecting the markets. The last few sessions, we've had this kind of news about China, but it hasn't always helped, right? It hasn't always meant that people are out there buying stocks and selling bonds, because there's concern that although they're reopening, the infections are on the rise. I think, 37 million people got COVID in one day last week.
Well, and that's just a guesstimate, because the reporting of both cases and deaths now is very much in question in China, because they have relaxed all the curbs, but also are now changing the way that they calculate the actual tally of contagion in the country. And as it rips through so many areas of China, it is a question of if it is going to bring economic optimism, I will say, coming through, or if it actually is worse for the China growth story, at least in the near term, given how many people are going to be homesick. Definitely a question. But what we do know, Matt, is when China reopens in full force and it is back up and roaring, that is going to mean more commodities demand, and that could be a refortifying force in the global inflation story.
Right. January 8th, I think, is the day on which they're expected to open fully, or at least as fully as we've seen in the last 3 years. There'll still be masking, of course. I'm sure it's going to be required. There'll still be testing to get in. You have to have a test like 48 hours, at least 48 hours ahead of your flight to get in. But the question I have is, how much demand is there going to be, right? For example, international flights have been capped in China. They've been kept to a low level. So when that cap comes off, does that mean airlines are going to start scheduling a lot more international flights? Or
good question.
Are the travelers not really demanding those tickets right now? They haven't factored it into their plans, so they're going to take some time probably to ramp that up.
While we're talking about airlines, I want to actually shift the focus domestically as well, because if you were traveling over the holiday weekend, I hope you got where you were trying to go. And if you were coming back, you probably had a difficult time of that yesterday. Southwest alone responsible for 3/4 of canceled flights yesterday. They canceled more than 3,000. They say that could continue for days to come.
A lot of people are calling it Southworst today. It did have a much more difficult time with the weather than any of the other airlines. We'll hope they can get recovered, obviously, for everybody who's traveling out there. But 80% of their flights were canceled or delayed, and that's a real problem, obviously, for Southwest Airlines. We'll be watching that stock at the open this morning. Speaking of stocks, let's bring in right now the chief strategist at Interactive Brokers, Steve Sosnick, joins us this morning to talk about let's start with the good news we have, Steve, out of China. Is good news good news? We are used to economic data coming in, U.S. economic data in a positive way, offering optimism for the economy. That hasn't been good news for markets, because the concern is the Fed will then continue with stronger rate hikes. What about this China news? That also has been kind of undecided over the last few sessions. Is it good when they reopen?
Good morning, Matt. There is a lot to unpack in that. In general, yes, we've flipped to good news is good news and bad news is bad news. And the reason for that is we finally have come to grips with the idea that the Fed is going to be fighting inflation. You know, the idea of the pivot, the pause, the peak, all the other terminology that we used about the Fed finally, you know, backing off its desire to restrict monetary policy has finally gotten through to people. And so now, of course, the worry is, you know, will we go into recession or will we get a soft landing? So any economic news that's on the positive side is helping the non-recessionary story, and therefore is being treated as good news. And of course, the inverse in the opposite. China, though, is a bit more of a wild card because we want to see the economic growth, which would come from China, but we don't want to see them contributing to inflation. And I think this is going to be a very muddled story for a while because, as you noted, that the full reopening occurs in a couple of weeks, but then a couple of weeks after that becomes the Chinese New Year, and it's going to really be the first time for everybody to be traveling around the country. And that's going to be very interesting in terms of how COVID spreads in that environment. So I don't think we can really take our eyes off that story for some time. And that's really the wild card here at this point.
If we do have China opening up and coming back in terms of growth, right? If we get 5 or 6% growth out of China in 2023, how helpful is that for the rest of the world economy? In other words, are they still a driver of global growth, or have we seen enough deglobalization post-pandemic that they don't really contribute as much?
I think we've seen some deglobalization, but hardly fully decoupling. And remember, China was more or less for the better part of, earlier this century, as a lot of the other world economies were muddling along, China was kind of pulling the rest of the world up at various points. So I think there's a hope that they can do that again. Again, it remains to be seen, though, because they've got their own issues internally in terms of shadow banking and overextended real estate and a whole bunch of other issues that also need to be reckoned with. So I think China is not as clearly a black and white story as it used to be, which is if China's growing, that helps the world economy. Now there's a lot of shades of gray in that story, and that's what bears watching.
As we talk about the world economy, or the U.S. economy in particular, there seems to have now formed a real consensus out there, Steve, that we are going to have a dire economic picture in the first half of 2023. Therefore, the markets are going to have more downside to come, at least in the first part of the year. But the consensus is that look into the second half, things get a lot better, and we actually could rally back up to essentially the levels we are at now. Are you worried about how much consensus there is around that idea? Does that essentially mean that is not what is going to happen?
Yeah, Kelly, that does make it tricky because, consensus tends to often be wrong, and markets have a nasty way of penalizing the largest number of people at the most inopportune times. Equities and bond markets do tend to disagree a little bit because the Fed funds futures market is still not exactly predicting a rip-roaring economy for the second half, and they're still pricing in a bit of recession. So something's got to give. And my experience, my gut always tells me, if you're making a bet on the economy and you got to choose between the stock guys and the bond guys usually have the economy sussed out better than the stock people. Now, that said, the bond people were drastically wrong about 2022 as well, because they sort of had a rate, terminal rate at this point below 1%. So take that with a huge grain of salt, of course.
Yeah, very valid point. And what we actually got was more than 400 basis points of hikes in the span of 9 months. So how quickly things can change, Steve. You mentioned what is actually priced in and what is not. What would represent a buying opportunity? At what point are we going to know what is the signal that the bottom is actually in?
I think when it's clear, well, first of all, number one, when we're no longer fighting the Fed, and we are still fighting the Fed. And remember, even if the Fed stops raising rates, they're still doing quantitative tightening. So problem number one is we probably want to find a point where it's obvious that we're no longer fighting the Fed in terms of the monetary tide. Secondly, I think we want to find a spot where it appears that earnings revisions are going to start going up. Right now, the big fear is that earnings are going to be stagnant or get revised lower, and everybody's going to be worried about, within 3 weeks' time, earnings season rolls around again. What do they have to say? And I think when it becomes sort of evident that earnings have started to turn a corner, or at least not really get materially worse. And again, U.S. companies have been remarkable at their ability to be responsive to bad economic times. Those are your two big signals. I don't see them right yet. That doesn't mean they can't be around the corner imminently, though.
So what about valuations and earnings, Steve? I mean, right now we're trading at 17 times forward earnings. How low do we need to go before a bear market ends? And what kind of earnings do you expect when we talk about forward earnings?
Well, in terms of what sort of valuation, I think, given our current interest rate environment, I think we, if we really want to see a washout, we're probably talking more like 15, 16 in terms of PE. In terms of actual earnings numbers, I think that really becomes economically dependent. Ideally, we could start to go back to double-digit growth, and if those start to be consensus projections that actually can be realized, well, that's obviously a good sign. But in terms of the valuation, my bigger worry right now is that I think a lot of investors are still in the cult of the growth stock. And I think what 2022 showed us was the difference between growth and value, the arbitrary difference between growth and value stocks is more or less gone. And I think what we need to be doing now is thinking of even our classic growth stocks, how do they shape up on a value metric? And I think that's really the more important thing going forward, is taking a look at what you consider your growth stocks, and are they decent values? And if they are, well, then that's a great situation. If they're not, well, that still harbors a lot of risk, and that we need to watch. That mentality, I think, needs to get a little more washed out before we turn up.
Steve, thanks so much for joining us. Really appreciate you coming on the program. Steve Sosnick there of Interactive Brokers talking to us about these markets. And I think, Kailey, the question is going to be for most of our guests today and this week and over the next couple of weeks is, when do you know, right? Yeah. What is your sign that it's time to stop selling the rip and start buying the dip, if you will?
Yeah, because none of us have a crystal ball. So any hints anyone has, we'll take them.
Coming up at 7:45 a.m., Dan Ives, Senior Equity Research Analyst at Wedbush, talks tech with us after the horrible, awful, no good year that 2022 was for the bulls. This is Bloomberg.
Keeping you up to date with news from around the world. With the first word, I'm Ritika Gupta. China is reopening its borders to the world by removing the final COVID-0 restrictions. Starting January the 8th, Beijing will no longer require inbound travelers to quarantine. They'll only have to obtain a negative COVID test within 48 hours. Meanwhile, the Chinese government may also reduce the frequency of reporting cases, ultimately changing to a monthly report. In western New York, at least 28 people are dead in one of the worst weather disasters ever to hit the region. More than 4 feet of snow fell on the city of Buffalo. Cars were buried in snowdrifts, and emergency crews could not respond in time to medical crises. But President Biden has offered federal assistance. Meanwhile, Southwest Airlines expects that the chaos caused by the storm in the U.S. to last for another few days. CEO Bob Jordan told the Wall Street Journal the carrier expects to operate just over 1/3 of its typical schedule so it can get crews in the right positions. Southwest canceled almost 3,000 flights on Monday. Russia's foreign minister warns that Ukraine must surrender or face continued war. Sergei Lavrov spoke to the state-run news agency TASS, saying that Ukrainian surrender was for its own good. Lavrov's remarks came as Russian troops have been forced to retreat in a series of damaging defeats. In South Korea, the military says it sent drones across the border into North Korea for the first time. It's an unprecedented move that followed North Korea's decision to send 5 unmanned aerial vehicles into South Korean airspace. North Korea's leader, Kim Jong-un, just opened a major political meeting to set security, economic and political policy. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
They've raised their inflation forecast.
Firm and immediate action.
He wants to destroy my country.
Elon Musk to buy Twitter.
Overturned Roe versus Wade.
Boris Johnson will call it
Donald
quits.
Trump's plan to overturn the
unprecedented search warrant at the home of our former president.
Queen Elizabeth has died.
Xi Jinping got his third consecutive term. The pound falls to an all-time low.
The shortest ever serving prime minister.
Presidents Biden and Xi shake hands.
FTX filed for bankruptcy.
The red wave that never was.
Protesting his zero COVID policy.
We anticipate a very strong recovery, especially from the Chinese demand for commodities. And I would differentiate that from other type of goods because China, by far, we believe that the fiscal support required to get to their GDP growth goal will be significant. Stronger infrastructure spending can make a significant difference in terms of growth rate.
That was Darwei Kung there, DWS portfolio manager, also head of commodities, talking to us about his outlook for 2023. And it'll be a very different year indeed, because the gigantic economy, second biggest in the world and fastest growing Chinese economy, is opening up again. Bloomberg's Alan Wan is in Shanghai for us to talk a little bit, Kailey, about what's going on. Alan, what do we know, first of all, in terms of the headlines? What has been dropped in terms of the COVID curbs, and I guess really what remains to go?
Yeah, I mean, really, this is the last big one, right? From January 8th, the government is ending quarantine for overseas arrivals. And this policy, has really hurt the economy and left China isolated from the rest of the world. I mean, that said, China is still going to require arrivals to show 48-hour PCR test results. But you know something? That's nothing compared to what we have right now, which is 5 days, at least 5 days of hotel quarantine and another 3 days at home of home monitoring. I myself, I've done like 2 long quarantines after leaving China and coming back, one for 10 days and one for 14 days. And I can tell you, they're pretty brutal.
Yeah, no, I believe it for sure. We were talking earlier about the international flights. They're currently capped in terms of the number of planes that can come in. Is there demand to lift that cap?
Oh, for sure. Actually, yeah, they're. I think one of the things they're saying as well is that they're going to remove that cap. I got to double check that. But right now, there's such huge demand for flights into China. In Hong Kong, I was just checking this out. But on the online searches for flights from Hong Kong to mainland China have surged 6-fold on some of the websites like Ctrip and Trip.com from last night compared to where they were a week ago.
Well, there's also the question of people traveling elsewhere from China. I know Japan is going to require testing. Given the rate at which infections are climbing in China with all of these restrictions suddenly released and the vaccination rate still not quite where it would have needed to be in order to insulate the population from the effects of rising contagion. Do we have a real sense, Alan, of what the numbers actually are, given the government's reporting of this now is in question?
Yeah, I mean, that's a great question. I mean, China has officially been reporting at 3,000 to 4,000 daily infections, which sort of fly in the face of everything we've been seeing on the ground and even what some of the provinces have reporting. I know Zhejiang province, which is next to Shanghai, reported 1 million COVID infections and expects another million more before it peaks. In terms of what China is going to do about it, I think right now it's pledged to increase ICU beds, increase the number of hospitals. They're going to retrofit a lot of these quarantine facilities into hospitals in order to deal with all these patients.
Alan, it raises a question as well of what the feeling is now from the Chinese population on the ground, because we know back in November, they were demanding an easing of restrictions. There were actually protests, the kinds of which we haven't really seen often in China, so outspoken on the rules under which people were being forced to live. The government seemingly has responded directly to that and says, okay, now we're just going to make all of those go away. Now that it has, and so many people are getting sick, I wonder if sentiment has turned the other way. I mean, what do people feel right now?
Well, I think there are a lot of mixed emotions. I mean, people are just mainly getting whiplash, right? One second, we're told that COVID zero is the end of the world. The next second, it's let it rip. I think a lot of people, so far, I mean, it seems that a lot of people have had COVID. According to the National Health Commission, about 18% of the population, about 248 million people, already have COVID. So what that means is a lot of people already have it, and they've gone through it, and they're sort of getting accustomed to the idea of moving along. But there's still a lot of old people who are actually, who haven't been vaccinated, and we're seeing a surge in, of old people going to hospitals, and even unfortunately old people dying. So there's a lot of concern, especially for people like they really care about their parents and their grandparents. They're really afraid that they might get COVID, and if they're not vaccinated, they might die. So there's a bit of a concern about that. But I think by and large, people are sort of getting used to the idea that COVID-0 has ended, and that's a good thing. There are going to be a lot of bumps along the road. I hear that in Beijing, we're sort of reaching the peak, or near the peak. Shanghai are not quite there yet, but nevertheless, I think that people are sort of, especially younger people, are getting used to the idea of moving past COVID-0.
It's interesting to get the inside take, Alan, because here we get a different picture, right, Kailey? The idea was those protests represented people fighting to get out.
Right.
They were being held in, and they wanted to escape these COVID-0 restrictions. And then, what we heard here was that as soon as they started to reduce the restrictions, the very same people were staying inside.
Yeah.
They were terrified of getting COVID at that point, because then the infection shot up. So it's interesting to get Alan's perspective about, what people really feel on the ground there.
Right. I guess it's a question of moving around or not moving around because you are mandated that you cannot leave your home versus you making your own decision and having that personal authority to do that. Maybe that is the distinguishing factor here. Alan, you mentioned hospitalizations there briefly, the idea that older people are going into hospitals. Are the hospital systems in China prepared for this kind of surge?
Unfortunately, no. I believe it's like 10 to 13 beds per 100,000 people, something like that. It's pretty low compared to Western standards. And that's why China right now is rushing to get older people vaccinated, and as well as they're increasing ICU beds. They're downgrading management of COVID from highest level to the second highest level. Basically, what they're saying is that COVID is no longer as lethal and serious as we thought. It's more like the flu or some other kind of illness. So China is sort of trying to downplay the seriousness of COVID, which is sort of what we've been seeing in the West as well. But in terms of hospitalization, I mean, they're on the rise, and unfortunately, a lot of old people are not vaccinated, and it's very serious.
Alan, thanks so much for joining us. Bloomberg's Alan Wan there talking us through the reduction of the COVID-0 restrictions, the end really of that policy coming on January 8th. It's interesting. I've been following the twists and turns of these headlines through the oil market, right? Because every time the restrictions are lifted, I expect to see oil shoot up in price, assuming that there are going to be another couple 100 million people filling their cars up. We haven't really seen that, but we've seen a ton of volatility. I'm looking at the Brent price now, Brent crude being the global benchmark, up to about $100 at the beginning of November, down to $75 at the beginning of December. So the volatility has been pretty incredible to watch.
I guess it's a question of, is more growth in China enough to offset what is going to be weaker growth or a lack of growth entirely in so many other parts of the world? It seems the oil market now is pretty singularly focused on the risk of recession and that bringing demand down versus supply, as we've been focusing on for so long. But I would say the China story is rippling across commodities, not just in oil. If you pull up GLCO on your terminal, gives you a read across the commodity complex, pretty much everything is positive today. Copper is up a couple percentage points at this point.
Dr. Copper looking at a little gain there. Yeah, everything except for aluminum, it looks like, is gaining this morning. And we have real jumps in natural gas prices here in the U.S. as well. We've been used to seeing that in Europe, of course. It's been a real concern that we'd get a cold winter there and they have limited supply. Here in the U.S., it's gotten extremely cold. It's caused real problems. Numerous fatalities, and natural gas prices are jumping. Coming up, we're going to talk to an economist about all this stuff. Julia Coronado joins us, president at Macro Policy Perspective. She's got experience on the Fed. She's got experience at Barclays, and she teaches at UT Austin. This is Bloomberg. Welcome back to Bloomberg Surveillance. I'm Matt Miller alongside Kailey Leinz. Lisa, John, and Tom are off today. And all week, are we on this show all week together?
We are. I think Lisa's coming back at the end of the week, though.
All right, excellent.
But you and I will be here all week.
A lot of fun. We're strapping in for the long haul. Let's talk a little bit about markets right now. We have seen a lot of green on the screen in Europe. Gains, not in London. I think London is still closed today, right? But the rest of Europe is open right now, and we're looking at gains in U.S. futures as well. Kriti Gupta, just back from London, is here with us to give us a look at the markets this morning on this. I don't think there's an official name for today, the day after Boxing Day.
It's been like a month, Matt, since I've been back from London. But nevertheless, those markets are closed, and you are seeing that sentiment story cross over from Asia. And you can see that really kind of flying high when it comes to futures. Take a look at the S&P 500, up about 0.7%. But to me, I got to put some extra emphasis on those small caps. The Russell 2000 futures up as well, and really outperforming lately. If you look at the equity trade on the good days that the equity market has, the Russell really does outperform. And on the bad days, the Russell doesn't do a whole lot of anything. So you are starting to see a little bit of this kind of intention with investing in the small caps. The idea that if the U.S. can actually hold its own better than the rest of the world, small caps may be the place that is actually underpriced. So seeing a little bit of that, even though the trading is on low volume. But Matt, to your point, European stocks, I should say, are higher as well. The real outperformance in that continent coming from France, of course, the entire index up about 0.4%. But speaking of Europe, this is another really fascinating story. I was nerding out with Kailey about this on Early Edition. The idea that one of the major stories in 2023 is going to be that weakness in the dollar, essentially the bear case for the greenback now building as the Fed gets closer and closer to ending their tightening cycle, which means that the euro is going to likely be the biggest beneficiary because the ECB is likely to lag a little bit when it comes to ending their tightening cycle. Nevertheless, this morning you were seeing a little bit of that 106 on that currency pair. And I should say, as we talk about the bear case for the dollar, it's going to have a ripple effects into the commodity complex as well. We're just kind of dealing with a double whammy when it comes to the China story as well. The reopening story really showing up in copper. That is up about 3.3% on the day, really kind of hovering around session highs. But the entire commodity complex is benefiting. Think palm oil, think agriculture. All of it is in the green. Brent crude is, of course, the trademark we like to look at. 84 handle, higher by about 1.2%. Nothing to write home about, but still green on the screen in line with that risk rally you saw in the stock market. I'm going to end here on gold because at the end of the day, the Lunar New Year is also coming up in China. So the idea that the reopening plus the Lunar New Year demand that's built in at the end of January, that fueling gold as well, up about 0.7%. Matt and Kailey.
All right, Kriti Gupta, thank you so much. Of course, the China story feeding into the commodity story, which means higher prices and could fuel inflation as well, something that central banks around the world have been trying incredibly hard to fight over the course of 2022, likely to be a defining story in 2023 as well. So on that note, let's get over to Julia Coronado. She is president at Macro Policy Perspectives, joining us from a very chilly Austin, Texas this morning. Julia, great to see you. We were speaking with Steve Sosnick of Interactive Brokers at the top of the hour, and he was talking about markets now that are still fighting the Fed. How hard is the Fed going to have to fight back in the new year?
Well, the Fed has sort of shifted its strategy. It sort of signaled both a hawkish stance at the December meeting in the sense that the consensus on the committee is higher rates than the market is currently pricing. But they also sort of signaled a downshift in the pace, another downshift to 25 basis points per meeting. And that allows them, I think, to both proceed with caution and feel their way to what is the right sort of restrictive degree of restriction to put in place, and also hold the threat of rate hikes over the market for longer. Chair Powell's been frustrated by some of these rallies in the market, these undesirable rallies that ease financial conditions when they're trying to slow the economy down. By holding a longer string of rate hikes over the market, I think that they hope to kind of prevent that relief rally that you're sort of alluding to, that they can hold markets in check for a little bit longer and make sure that the economy really does cool down enough to cool those underlying inflation pressures.
Well, on that note, Julia, if it really all is going to come down to the trajectory of inflation, I love the way that our team at Bloomberg Economics put it when they released their inflation outlook for 2023 this morning, saying the story of 2022 was how fast inflation rose. The story of 2023 will be how fast it falls. What is your expectation on that speed?
Yeah, so I think it's going to really gather steam in the latter part of the year. And we sort of all know that. There's these leading indicators of housing, of rental inflation that have really rolled over. But we know there's a lag from the time that happens to when it feeds into the official inflation metrics that the Fed is targeting. And that lag should be kicking in sort of towards the latter part of 2023. In the first half of the year, they're going to be dealing with stickiness, those second round effects from higher wages and higher prices in the pipeline that sometimes ripple through into services. So they've kind of broken inflation into three buckets: the goods inflation that was disrupted by the pandemic, rental housing inflation, the single biggest component of core inflation, and then sort of all other services inflation. And that's really where they're taking the temperature of the labor market, of consumer price sensitivity. That really hasn't, it's sort of stabilized at a high rate. They'd like to see that come down. And that probably is going to take some time.
Isn't the third bucket the hardest, Julie? I mean, from my understanding, services is the hardest piece of inflation for the Fed to affect because, you know, with goods, certainly with something like, you know, car sales or home sales, they can easily raise rates and limit the number of buyers who can afford to come in. In terms of services, do they have to just cause real economic pain to bring those prices down? Do they have to, you know, knock mom and dad out of work? Do they have to put people on the unemployment line in order to get services inflation down?
You know, that's one possible outcome. We don't really know for sure, but I will say this. The pandemic disrupted services inflation as well as goods inflation. Think about hotel rates, airfares. They've done a lot of busting and booming through the various opening, closing waves. And we've seen that actually. One of the key tests here is that when will consumers become more price sensitive like they were before the pandemic? Before the pandemic, it was notorious that there was no pricing power. Consumers were budget conscious. They wanted deals. And then that all went away when all they could buy was goods in the lockdowns during the pandemic. Now, and then reopening, there was this sort of revenge travel idea. Now we're sort of settling into a more normal consumer. I think we saw that this holiday season. Consumers do want deals. They are aware of the limitations of this boom that we've been in the last year and a half. They're more aware that there are clouds on the economic horizon, and they're responding accordingly with being price sensitive. And that's really key to cooling inflation without a deep recession, is that consumers start demanding deals again, and that companies are going to have to, you know, meet them in the middle. And they haven't had to. Think about these pass-through of car costs that you just mentioned.
Yeah.
Unimaginable a couple of years ago that consumers would simply accept a 50% increase in used car prices. But consumers now, they've got a broader basket of goods and services they can spend on. We saw that with airfares, Matt. We saw that somewhere around the fall, consumers started canceling trips if they couldn't find the right airfares. They were deal hunting. And airlines had to respond accordingly. So I think we're getting back into a more normal zone of consumer price sensitivity. And that's really key, because that would allow the Fed to cool that services inflation without a very deep recession.
What about people
just
waiting?
Because consumers go back to their old bargain hunting ways.
Julia, you know, a lot of people in the housing market currently are on the sidelines because they're looking at 6, 7%, 8% mortgages maybe. A lot of people, you know, I want to buy this year, next year, I want to buy the last Dodge Challenger Hellcat. They'll never make one again. 2023, I think it's the 15th year of them building that gigantic muscle car, and they'll never build one again. But Chrysler right now is offering me 7.29%. I'm not going to finance at that rate.
Right.
If I wait till the end of 2023, are those borrowing costs going to come back down?
By the end of 2023, but remember, we have to go through the soft patch or recession first before we get to that relief. The rates are high right now to cause the pain that you're describing, to cause the reaction of, you know what, I'm not going to buy this car because rates are too high. I'm not going to buy this house because rates are too high. That is the demand cooling the Fed is looking for. And we are seeing it. We have seen, despite better production of new cars, better availability, car sales have been kind of languishing still because the rates of financing a car loan have shot up so much. Consumers are looking at a big jump in payments for a new car or any car. And so they're responding accordingly. We're seeing used car prices fall pretty consistently in the last few months after soaring in the last couple of years. And we first saw some softness in new car pricing in the last inflation report. We would expect that to follow through into the first half of the year. Some actual discounts on MSRP. Imagine that, if you will.
All right, Julia Coronado of Macro Policy Perspectives, thank you so much for joining us. You know, Matt, I sit next to you every day as we anchor together, and I know you shop for this car in commercial breaks. I know you were considering 2 colors. Have we decided on the green or the blue?
I've decided, I think, on the Frostbite blue.
Oh, Frostbite blue.
My other choice was the F8 or Fate green.
I love the names of colors for cars. Like mine is a shadow metallic. I think that's
pretty good. I feel like Dodge maybe has the best names with Mango Red and Tor Red and Mango Orange. They also have, I think, Black Eye, which is like a purplish color.
Oh.
But that's
I'm not sure I like that one.
Car.
The other ones are cool.
Yeah, Frostbite, I think, is going to be it for my Challenger Hellcat. Coming up at 7:15, we're going to talk to Isaac Boltanski, Policy Research Director at BTIG. Now, this is going to be interesting because he's going to talk to us about legislation we can expect to pass or not to in 2023. Everything from cannabis to financial regulation. Of course, we'll talk about crypto as well. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. President Biden has declared a state of emergency in New York, where a massive storm dumped more than 4 feet of snow on the city of Buffalo. At least 28 people have died in the region. Meanwhile, Southwest Airlines is still struggling with the nationwide effects of the storm. It canceled almost 3,000 flights Monday. The carrier expects the chaos to last a few more days. Power grids in Western Europe will get a break going into the new year. Warmer temperatures will reduce the strain on energy systems, which was stressed earlier this month by the first cold snap of the winter. Forecasts call for high temperatures of 16 degrees Celsius in Frankfurt. That's more than 10 degrees higher than the 30-year average on New Year's Eve. In Ukraine, the foreign minister is calling for a peace summit at the United Nations within 2 months. But Dmytro Kuleba tells the Associated Press he doesn't expect Russia to take part. Kuleba says Moscow must face a war crimes tribunal before Ukraine engages in direct talks. A UN spokesperson says that Secretary General Antonio Guterres can mediate, but only if all parties want him to. Taiwan is sending a signal to the U.S. and China that it's serious about defending itself. President Tsai Ing-wen is extending compulsory military service for men from 4 months to 1 year. Taiwan has been working with the U.S. to strengthen its defenses against a potential Chinese invasion. And Peloton has begun selling refurbished bikes at discounts up to $500 below new model prices. The bikes will cost anywhere from about $1,100 to $2,000. Last month, Peloton disappointed investors with a lower than expected holiday forecast. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Historically, usually the market has been right, but in 2022, it's been the Fed. If inflation is not on its way to 2%, the market will struggle. I've argued that inflation in the post-pandemic era, inflation is this story, is the game, and it will continue to be. And whether or not it goes back to 2% on its own naturally in 2023, 2024.
That was Jim Bianco there, president of Bianco Research, and he was talking about really market reaction to the inflation situation. What I think is interesting, and one thing, Kailey, that I think to ask Julia about, maybe I should have, is the possibility of the Fed easing their inflation target.
Yeah.
Letting it float up. This is the kind of thing that makes people angry, by the way. People will write in. They'll comment on Twitter. They have very strong feelings about it. But it has been put forward by a lot of credible economists that maybe we need to have a 3% target, or maybe it needs to be something a little bit softer than a single integer.
Yeah, I think it's a very valid question because, sure, you can have price pressures easing, inflation cooling. Cooling down to target, though, is something entirely different. And a 2% inflation target may just be for a world that we no longer live in when we're talking about perhaps a more permanently decoupled world when it comes to the U.S. and China. When we talk about lingering supply constraints as a result of the pandemic, 2% just may not be somewhere we can get down to. So it raises the question of what is going to be enough for the Federal Reserve? What number do they need to see where they can at least take their foot off the gas, maybe not hit the brake, but at least say, all right, I think we've done enough here. We're sufficiently restrictive. We don't need to go any further. But yeah, maybe 2% is not ultimately where we get back down to.
Right. A lot of that will be gauged from the market as well. Right now, we're looking at equity indexes up across the board in Europe. Of course, London is closed for a holiday. They're always so good about giving extra holidays in the United Kingdom. The rest of the continent is open and up. We're looking at gains in U.S. futures as well. You can see right now up 2/3%. So it looks to be a risk-on start to the day after Christmas, after Boxing Day. Let's get over to the big smoke right now. Ed Ludlow is in London on loan from San Francisco for a few days in one Chelsea game. Ed, what are you looking at over there?
Yeah, I think it's this idea that we just have a few sessions left in the month of December. But, you know, me being focused on technology, it's been a pretty rough month, right? We're on track on the NASDAQ 100 for the worst December in 20 years. And I think the market are kind of trying to look back at history, and particularly the NASDAQ 100 for a sense of where we'll go next. You know, you were talking about the Fed and inflation. That chart on your screen shows the NASDAQ 100 on a 182 session streak where it's failed to breach its 200-day moving average. That tells us nothing about the outlook for corporate earnings, particularly for mega cap tech, but it does give us a broad gauge of sentiment in the market. And I think that there's not a lot of optimism right now that we're going to break out on the NASDAQ 100, at least in an upwards trajectory anytime soon. And then you and I and Kailey can have a debate about the Fed and whether they're so focused on inflation or if it's just this strong jobs market data that's keeping us on this kind of dour path.
Well, Ed, when we talk about the NASDAQ 100, what we are largely talking about is just the mega caps, right? I mean, they make up the bulk of the index. Microsoft, Apple, Amazon, Alphabet, NVIDIA, Tesla. Put all those together and you got, what, a third of the index? So how much of this is about the stories for those individual names, which also have been absolutely given brutal punishment this year?
Yeah, it's interesting because, you know, historically in times of recession, I think we're getting towards a point where we're trying to see how these mega cap companies fare in a recession. You would argue, well, some of those names that you've just mentioned, Kailey, have the strongest balance sheets. They have entrenched market positions. But you look at those stocks, those worst performing stocks on the NASDAQ 100, which you see on your screen now, there's still questions about valuations and just the basics of the rate narrative, which is that higher rates discount the present value of future profits. And at a time where yields are kind of, okay, we've pulled back a little, but yields are still elevated, it makes those names on your screen much less attractive proposition. Yeah. I'm also kind of more broadly thinking about the NASDAQ 100, right? I think we're trading at 20 times 12-month forward earnings, which is off the highs of 2021 and this year, halfway or where we started the year. But against historic trends or averages, that's still pretty high. And the market does seem to be thinking actually valuations have a little way to come back down.
Against old economy stocks, that's high, right? I mean,
valid.
20 times earnings, if you're talking about FANG stocks, that's got to be low. Obviously, there's nothing with which to compare them because there wasn't a previous Facebook, right? There wasn't a previous Tesla, really. Meta. I guess the kids are going with Meta now and Alphabet. I'm still a Facebook and Google guy. But it's pretty interesting, Ed, that you're looking at 20 times on those big tech stocks. I know that's for the whole NASDAQ 100, but as Kailey said, that's the majority of the weighting. So, maybe 20 isn't so bad.
Well, you raise an interesting point as well, which makes me think about the private markets, that the private market still uses the NASDAQ 100 and the peers of the most attractive private sector names to base their valuations, right? That's a part of the calculation. And again, looking at the projections for 2023, the impact of higher rates, and then companies having to react in real terms to inflation, right? The risk for tech on inflation is that operating expenses outpace revenue growth. And in this kind of environment, that's not palatable. But I still think both the public and private market sectors look at that valuation level in the NASDAQ 100 and say, yeah, actually, we got a little way to run.
Well, Ed, speaking of one specific valuation re-rating, and it was one of the stocks that was on that board of worst performers you were showing, Tesla down 65% this year. This was $1 trillion company at the start of 2022. It's now less than $400 billion in market value. There was a headline that crossed earlier from Reuters about Tesla running a reduced production schedule at its Shanghai plant in January. There's been a lot of questions around demand from China, which is a fundamental factor of the company, putting aside Elon Musk and the key man risk as it relates to all the drama with Twitter. How does that stock turn things around? What are you hearing?
Well, again, Tesla, we always forget, is still a stock that trades at 30 times forward earnings, or slightly below that, I guess, now. So, it's still caught up in the narrative around higher rates. But the most recent anxiety does appear to be related to the questions of demand. I don't think anyone's drawn a firm conclusion that actually there is a demand worry definitively for Tesla. We'll have to wait until the earnings call for the next quarterly earnings to have that from Elon Musk or Zach Kirkhorn, the CFO. But there are signs, right? In China, they cut prices. There's been varied reporting on why they shut down production in Shanghai. Part of it is that they do annual maintenance to the assembly lines and they pause production in order to make upgrades that improve the ramp long term. Then you have the $7,500 incentive, a doubling of the incentive in the US for Model Y and Model 3 through to December 31st. So they're kind of conflicting, but there hasn't been a definitive statement from Tesla. And all the while, I don't know if you guys have seen, but Elon Musk is tweeting about the Fed quite a lot and the Fed's path to raising rates and about the global economy. So that's his suggestion.
The margin debt, Ed. So I thought this was really interesting when I saw the headline yesterday, Elon Musk warning about margin debt. And I'm thinking this guy must have had a ton of it himself if he doesn't have any left now, right? He has liquidated like $40 billion in Tesla shares.
Yes, he has. Bloomberg's most recent report about 3 weeks ago was that Elon Musk was considering, through his bankers, swapping out some of the unsecured notes of the $12.5 billion original package to buy Twitter for margin loan. You'll remember that in the early days of his efforts to buy Twitter, there was a margin loan component that was then scrapped. The issue is that when we reported that the margin loan could come back, that was when there was the most downward pressure on Tesla stock. And of course, a margin loan would be secured or collateralized against Musk's Tesla holdings. That caused a lot of anxiety as to why he was doing that. But as you said, he tweeted and appeared on a podcast published over the weekend saying, actually, that's an area of the market one should avoid, using one's own stock as collateral for debt. Even though that's what's been reported that he plans to do.
Ed, quick car question. You mentioned that Tesla is offering $7,500 off for, I think, the Model X or the Model Y if you sign up by December 31st. Next year, do we know, that's the same size as the tax credit that EVs got, right? Do we know which cars get that next year?
Well, so the biggest change is go and look at the Treasury guidelines that were postponed. And what they're doing is delaying the battery composition requirements. In other words, the origin of those metals, that provision was delayed. So a broader basket of vehicles should be eligible for it in the first instance.
Excellent. Excellent news. Always good to hear. Ed Ludlow, thanks very much for joining us from London. Good luck tonight. I know you're supporting Chelsea in Fulham, and he's a lifelong Chelsea fan, Ed Ludlow is. Go soccer. Thank you. Yeah, that's about the extent of the knowledge that Kailey and I have. Does Michel Ballack play for Chelsea still? I think that's probably long in the past. Coming up at 7:45, we're going to talk more on tech. We've got Dan Ives, senior research analyst, equity research analyst at Wedbush. This is Bloomberg.
2023 is very likely going to be the year of recession.
We might skirt a recession, or if we do a recession, it'll be relatively light.
It's an open question of, will we have a recession? When will it be? How deep and long lasting might it be?
If inflation is not on its way to 2%, the market will struggle.
Right now, the market is still being very overshadowed by the slowdown we anticipate.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Live from New York City for our audience worldwide, this is Bloomberg Surveillance, simulcast on both Bloomberg Television and Bloomberg Radio. I'm Matt Miller, in with Kailey Leinz.
Good morning, good morning.
Good morning, good morning. John Ferro is out, but also Lisa Abramowitz and Tom Keene are off. So Kailey and I are here for the bulk of the week, looking at markets that are kicking off this shortened holiday week on the upside, right? We got gains on futures this morning here. We've got gains in the European indexes that are open. London is still closed. It seems more civilized to me to stay closed for a couple days after Christmas.
Wouldn't that be nice?
Yeah.
Not that I'm not excited to be here with you, but I also would have liked to sleep in this morning. That would have been a nice gift to
Here you see the euro trading at $1.0655 right now. The 10-year at $377.52. So we had come down pretty substantially from the 4.25 high that we saw back in, I'm going to say November, down to the 350s, and now we're back up at 378. So very interesting there. NYMEX crude back up to an 80 handle. A couple weeks ago, we were looking at a 70 handle to kick off the week. We've seen a lot of volatility across commodities, but I guess right now the idea is China's reopening.
Yeah.
And as a result, investors are buying commodities again.
Yeah, not just reopening domestically within the Chinese economy, but reopening its borders to the rest of the world after years of being shut off. They're now going to back away from the quarantine requirements of inbound travelers beginning January 8th. That was really the last COVID zero policy that was remaining. So now we're dealing with the prospect of a fully reopened China. And yes, cases seem to be surging across the country and the death rate rising as well. But it does raise a question of once we get past that surge, once we see the peak and people are back out being active, demanding commodities and other goods within the Chinese economy, what does that do to the global inflation story?
Yeah, last week we had a headline that 37 million new cases were reported in one day.
Yeah.
Which is just mind-boggling, especially when you consider the fact that they're not testing, right?
They're testing differently.
Right. Well, not nearly as much is how I'd put it. Let's talk a little bit. Well, the question of the day, I think, and the question of the week is going to be buy the dip. Do you start to buy the dip now if you've been selling the rip and raising cash for the last few months? Justin Bergen joins us, Director of Equity Research at Ameriprise. And Justin, it's that turning point that Kailey and I are wondering about today that a lot of our guests are talking about. Of course, no one has a crystal ball and timing the market is difficult. But at some point, you have to make the decision, I've raised enough funds and I think prices are low enough, valuations are low enough that it's time to get back in. When do you see that point, Justin?
Hey, Matt, thanks for having me. And yeah, I agree. We should have a couple of days off instead of just one. So, I think if you look into 2023, our take from Ameriprise is play some defense going into the year. Okay, you've got your 2023 earnings have yet to come down to a reasonable level. They started at 250 back in June. They went to 230. That's where they are now, 231. We think they're going to come lower, that analysts are still too optimistic. So play a little defense going into 2023.
How much lower is lower, Justin? I mean, at what point do you say, okay, fair value, it's a safe time to start deploying some capital?
Yeah, so we have a target in that 210, 220 range for S&P 500 earnings. And if you look at where that comes from, so the sectors that have been hit hardest have been that discretionary in the tech side. Those continue to work lower throughout the year. And we have this thesis of consumers will move into more of a buy what you need versus what you want. And so if you can get into that 210, 220 range, It's going to happen. It's going to be a little painful. That's why we think you play a little defense from a sector perspective.
But thinking about what that means for the equity market as a whole, you mentioned discretionary, which is predominantly Amazon and Tesla and technology. We're talking about the heavyweights of this equity market, the ones that led the rally for so long and have led the downside this year as well. If it's not going to come for them, what leads this equity market? What can support it?
Yep, good question. So if you think, so our overweight sectors right now is kind of a barbell. So we have that traditional defensive sectors of the market, so staples and healthcare. And then we also have overweight on financials and tech. So 3 out of 4 of those have worked pretty well. But you say, where does that leadership come from? It comes from staples and healthcare. Okay, so I know that there's some talk around staples being too expensive, but those are the ones that are producing earnings growth right now. And that's very hard to come by. So that's where we think you stay, is in that defensive part of the market, led by staples and healthcare.
So in terms of dividends, I know I get your research and I read through Ameriprise stuff, and I know you have this sort of 3D strategy for the end of this bear market, right? You want to buy defensive stocks. That's why you're talking about consumers moving down. You want to get to those things that they need. You want to buy dividends, and that's been working really well at the end of this year, and you want to diversify, obviously. You want to move at some point from, an absolute dividend level to companies that grow their dividends. How do you pick those out? How do you screen for them? What companies, what sectors are you looking at?
Yeah, so you're absolutely right. So what makes it hard is you have, let's say, 350, 4% on a 10-year, and they got a 2-year at 430. So you can't go with, a company that raises their dividend a penny a year. So you look at companies that have that free cash flow, companies that have that ability to grow that dividend double digits, 10, 11, 12% year over year. There's plenty of names out there that you can buy with growing dividends in the double-digit range year over year.
What do you think about fixed income, Justin? What are you telling your clients? Because they've had, I guess, the worst year on record for rates. We're now seeing rates at levels that provide a decent return. If yield is becoming a bigger component of total return, do you advise your clients now to get in?
Yeah, so our fixed income theme is fixed income is back in 2023. And like I said, you can go out, you don't have to go out 10 years. You can go out 2, 3, 4 years and get phenomenal yields that you haven't had in decades. So absolutely. So 60-40 didn't work in 2022, but it is set up for a good run in 2023. And you can keep your duration relatively short, and you can pick up some very good yield.
So, in other words, Justin, RIP to Tina. Do we ever see a revival of that?
It may be some time. And look, it was years, decades, where rates were coming down and down. And you think about the setup for consumers, right? So if you graduated college right around the financial crisis, and you're here today, you're 40 and change. Not me, but some people are. And then right? So
not me
you
either.
have this, all right, but you have this expectation that rates should be zero. And
right.
that's not coming back anytime soon. We have that inflation that is going to be stickier than people think. That's one of the risks we think going into 23, is that you have that stickier inflation narrative.
I'll just clarify the acronyms, right? Not everyone maybe knows. TINA stands for There Is No Alternative. That was the idea that you had to buy stocks and there was nothing else. I think a new acronym was coined TARA.
Yeah.
There are
reasonable
alternatives. In any case, it does feel like we're moving into a completely different era, Justin, right? Because as you point out, people who are basically a little bit younger than me, all the way down to the youth of Kailey and Ed Ludlow, they've never seen anything but, if not zero, at least near zero interest rates. Does this mean, we're not going to see 10% a year gains in stocks from here on out? Are we going to never get back to that?
Yeah, so I think expectations need to come down, right? So we've had an incredible run, but it doesn't mean that you have there's some big massive sell-off. You just have to temper expectations. Maybe it's not going to be that 10% annual rate of return, but you can still have decent rates of return if you combine some good quality dividend names, combine it with some income that's generating 4 or 5% or going out 2 or 3 years. That makes a pretty good setup.
All right, Justin, thanks very much. Justin Bergen there of Ameriprise talking us through his strategies, what they're giving their clients at the end of the year. Maybe it's the right time to take stock, especially if we have this kind of inflection point. Obviously, the real inflection point that people are waiting for, Kailey, is the move from bear market back to bull market. We've had a few head fakes, right? These bear market rallies that we've seen. We're not in one right now. We're still under 4,000. What were the year-end targets? Strategists were expecting more than 4,000 for the year-end, right?
If you look back at what the average target was in December 2021, as we looked ahead to the year to come in 2022, the average was 49.50
for the S&P 500.
For the S&P 500,
that on your screen right now at 38.91.
We're talking about 1,000-point gap between what expectations were and what was the reality. Granted, there were so many things strategists couldn't have seen coming this year. War in Ukraine, 425 basis points of hikes coming from the Federal Reserve. So many forces that have worked against this equity market in a way that I don't think anyone could have anticipated. But it raises the question of, if consensus was so wrong this time around, could it possibly be right in 2023? Because the consensus is things will get worse before they get better, but they will get better come the back half of the year. And a lot of that thesis is predicated on a Federal Reserve that is going to pause and maybe pivot. And there's a question of, if we do have persistent inflationary pressures, could the market be wrong on that?
Well, and I also think it's interesting that the strategists we survey at least aren't expecting things to get much better by the end of next year, right?
I look at kind of where we are.
Lu Wang from Bloomberg News compiles expectations for us right now. Out of 22 strategists that she has surveyed, the average for the close at 2023, so 12 months and 4 days from now, is 4,078. Right now we're at 38.91, so not much above that. The median at 4,075 with earnings at 210. Doesn't look like we're going to get a lot of movement next year if you go by the strategist that Lu Wang has put together for you on your Bloomberg terminal. Right now we're looking at futures up 0.5%. Coming up at 8 a.m., Matt Maley joins us, chief market strategist at Miller Tabak, to talk more about these markets. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. China is reopening its borders to the world by removing the final COVID-0 restrictions. Starting January the 8th, Beijing will no longer require inbound travelers to quarantine. They'll only have to obtain a negative COVID test within 48 hours. Meanwhile, the Chinese government may also reduce the frequency of reporting cases, ultimately changing to a monthly report. In western New York, at least 28 people are dead in one of the worst weather disasters ever to hit the region. More than 4 feet of snow fell on the city of Buffalo. Cars were buried in snowdrifts, and emergency crews could not respond in time to medical crises. President Biden has offered federal assistance. Meanwhile, Southwest Airlines expects that the chaos caused by that storm in the U.S. to last for another few days. CEO Bob Jordan told the Wall Street Journal the carrier expects to operate just over 1/3 of its typical schedule so it can get crews in the right positions. Southwest canceled almost 3,000 flights on Monday. In South Korea, the military says it sent drones across the border into North Korea for the first time. It's an unprecedented move that followed North Korea's decision to send 5 unmanned aerial vehicles into South Korean airspace. North Korea's leader Kim Jong-un just opened a major political meeting to set security, economic and political policy. Despite well-publicized layoffs in the tech industry, most of the workers affected are finding new jobs quickly. That is according to a survey by ZipRecruiter, quoted in the Wall Street Journal. The survey says about 79% of those hired after losing jobs at a tech company found new jobs within 3 months. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
They've raised their inflation forecast.
Firm and immediate action.
He wants to destroy my country.
Elon Musk to buy Twitter.
Overturned Roe versus Wade.
Boris Johnson will call it
Donald
quits.
Trump's plan to overturn the
Unprecedented
election.
search warrant at the home of our former
Queen
president.
Elizabeth has died.
Xi Jinping got his third consecutive term. Pound falls to an all-time low.
The shortest ever serving prime minister.
Presidents Biden and Xi shake hands.
FTX filed for bankruptcy.
The red wave that never was.
Protesting his zero COVID policy.
I mean, I still think it's an open question of, will we have a recession? When will it be? How deep and long lasting might it be? So there will be some disconnect here between, say, where equity markets are and bond markets are. It'll be hard for equity markets to price in. I do think it'll become more noticeable that the rate of inflation is slowing.
Michael Gapin there, Bank of America Securities, head of U.S. economics, talking about a number of the issues that we've been covering on this program this morning and will continue probably to cover for the next year. What happens with inflation? How does the Fed react? The market continually fighting the Fed, it seems like, with these little rallies that we have, and then being put back in its place by Jerome Powell at each consecutive meeting. Right now, we're looking at a little bit of optimism on the screen. S&P futures up a little bit more than 0.5%. We're seeing gains across Europe. Right now, you see a stronger euro against the dollar, 106.49. And of course, when you have the dollar weakening, that's always good for risk assets, or at least it has been this year. The U.S. 10-year yield right now up to 377.33, so gaining a little bit of strength as investors feel comfortable enough to let go of the perceived safety of government debt. And NYMEX crude trading at $80 a barrel even, up right now about about 0.5%.
Yeah, and of course, a lot of that has to do with the China reopening story, the idea of growth reviving in the second largest economy in the world. Here in the U.S., though, Matt, as we talk about a Federal Reserve that has tightened policy aggressively this year, is expected to continue tightening next year, at least in the first part of it, a recession is seen as the likely scenario at some point in 2023. And it raises a question, as you have growth deteriorating, the removal of monetary policy accommodation, are you going to get any kind of fiscal accommodation to offset the weakness in the economy, as we have seen over the course of the pandemic? But at the same time, as we enter 2023, you're going to have a divided Congress, and it raises a question of if any of that can actually realistically get through, or if there's just going to be no support whatsoever.
Yeah, typically gridlock is good, right, for markets. On the other hand, the fiscal stimulus, the mountains of fiscal stimulus that we got over the past couple of years have been necessary to drive the markets. And when that tap was turned off, it seems like the markets came down as well. I should mention Kailey Leinz and Matt Miller. We are in for Tom, John, and Lisa. They're off on a well-deserved, I think they're together. Did they go away together for
Probably.
this
Tom
vacation?
Would call it a sabbatical.
A sabbatical of 1 week. Let's talk about what to expect in terms of policy in this divided Congress that we will see sworn in to kick off 2023. Isaac Boltansky joins us, Policy Research Director at BTIG. And Isaac, you've looked deeply into what's happening in terms of the legislative agenda for next year, even before we're finished with the legislative agenda for 2022. Do we finish everything here? Does the Congress just call it quits and start afresh? What are you concerned about business that hasn't been done yet?
Look, this was actually a very busy Congress. And despite all of the headline volatility that all of us had to live through, they actually accomplished a fair amount, from the infrastructure bill to the IRA to this massive $1.7 trillion spending bill that just came through. And look, we're still all combing through that 4,100-page document. And it reminds me, Matt, of that old saying that camel is just a horse that's gone through the legislative process. There are lots of things that are crammed in there that we're still figuring out. But that is the last and final part of business of this Congress, and they get to start again next year. And it's going to be materially different next year, given the composition, which is what I think we're all now focused on.
So next year, I mean, there are a number of smaller issues. I'm focused on what's going to happen with cannabis and the Safe Banking Act. Maybe bigger for a lot of people in this state, what's going to happen with the state and local tax deduction. Will we get that back at any point? But there's also the crypto regulation we have to look forward to, other financial industry regulation, energy policy that we have to focus on. Are we going to be able to drill more? Is this administration going to be more friendly to that sector as we need more stock? What are you most focused on, Isaac, for 2023?
Yeah, look, I think with its divided government, we're not going to have these big, massive legislative vehicles that we've seen over the past 2 years. So it is going to be the equivalent of a legislative grab bag. What can be attached to the appropriations bill in the fall on page 900, right? And so here's how I think about it. On the energy side, we are still optimistic that we will get some degree of permitting reform in the first quarter. It remains to be seen exactly what shape that legislation takes, but there is clearly enough political will for that, and that's something that I'm optimistic about. I also think that we should expect some crypto legislation. Now, here, I don't think you're going to get the massive comprehensive bill that some want. Instead, I think it's going to be more narrowly targeted to stablecoins, because that's something that Congress understands, kind of like a money market fund, kind of like a deposit account. They can get their arms around that. Beyond that, I think I'm mostly going to be focused on how does Congress interact with, the regulatory state here in D.C. And we have some acronyms that I think are going to play a big role in 2023, such as FTC, CFPB. A lot of these regulatory entities are going to get far more active, which is going to have real repercussions for the market.
Okay, so those are a lot of very specific policy areas, Isaac. If we can talk about just macroeconomic policy for a second. Matt and I were talking about the dynamics between monetary and fiscal policy, how both were so accommodative. There was so much stimulus a few years ago. Obviously, this is a very different story now. And when you have a Republican House, the likelihood of getting any further fiscal spending through is probably pretty small. So if we do indeed get a U.S. recession next year, what would you expect the reaction from Washington, D.C. to look like?
I think it's going to sound like crickets, Kailey. I really do. I think, I'm a fan of that saying that history doesn't repeat itself, but it often rhymes. And the last time that we had a Republican House and a Democrat in the White House was the 2011 to 2013 time period. And during that time period, we had legislative logjam, fiscal brinksmanship, fights over the debt ceiling, and what passed for fiscal austerity here in D.C. was something called the Budget Control Act, which had mandatory sequestration. And so, look, just as we have talked about the Fed put disappearing, I firmly believe that the fiscal congressional put expires the minute the new Congress is sworn in a couple of days.
Well, speaking of who's getting sworn in a couple of days, I do want to get your take, Isaac, on one of those elected congressmen in particular, George Santos, the Republican here in New York, who has now admitted essentially to embellishing his resume about his college degree, about working at two major Wall Street firms.
He left something out as well, right?
There were many
things. He was previously
things.
married?
And he was previously married. There's just a lot of different points of contention here, yet he says he still plans to take the oath of office on January 3rd. I'm just wondering what your reaction to these revelations is.
It's shocking, it's disappointing, and it's not at all surprising. I think as we've whittled away what the truth is when it comes to our political discourse, these things are going to continue to happen. I'd be interested to see if he actually makes it. I think that part of the strategy now is to just hope that the story dies down over the next few days. I struggle to see that happening. But once he gets into Congress, I would tell you, I think that it's going to be very difficult for him to actually legislate effectively, because he will carry a degree of toxicity with him from these stories. But this is, in a lot of ways, the new normal, given where our political discourse is.
He uttered the words, "I am not a criminal," in an interview with the Post. Those are never good words to have to say. Isaac, thanks so much for joining us. Isaac Boltanski of BTIG talking to us about what to expect for 2023 out of Washington, D.C. Thanks very much. Now, in terms of what we're looking at right now, futures still up about 0.5% here, kicking off the shortened trading week. We do have gains across the continent, with the exception of the UK. London is closed today for a holiday, but we're seeing gains in France, Germany, and Paris. You can see S&P futures here, 0.6% gain. The euro at $1.651, and the 10-year yield trading at 377.14. We're going to talk to big tech bull Dan Ives, managing director and senior equity analyst at Wedbush, next, about when those stocks can come back. This is Bloomberg. Welcome back to Bloomberg Surveillance. I'm Matt Miller here in New York with Kailey Leinz. Tom, John, and Lisa are off this week. We're looking at gains in terms of U.S. futures, European equities up across the board as well, although London is closed this morning. Let's get over to Kriti Gupta. She's got a market check for you right now. Kriti?
Yeah, Matt, a little bit of green on the screen. You can see it in not just the equity market here stateside, but you can see it across the ocean as well. It's the S&P 500 futures up about 0.5%. A real outperformance, though, in the small caps, and that's going to continue to be a theme potentially into early 2023. Remember, you want a broad rally, which includes small caps and big tech all together to really have a sustainable turnaround in the stock market. We're seeing early signs of that, at least this week, although given on low volume. So those Russell futures up only about 0.7%. But across the Atlantic, over in Europe, you mentioned that London is closed. Well, the rest of Europe is indeed open. The stock 600 is higher on the day. But I want to look at some of the currencies here because you are actually seeing the commodity effect really coming from the China story, the reopening story, kind of have an effect into the currency market. Euro dollar, I'm going to start from the bottom up here. Euro dollar at 106. And this is important because as you start to see the bear case for the dollar really building, it's going to kind of go into more of those cyclical currencies. The euro is one of them. The others are those commodity exposed currencies. Think the Aussie dollar, think the Canadian dollar as well, both which are stronger on the day following the story you're seeing in Brent crude and the entire commodity complex higher. And then Matt, Kailey, forgive me, I got a little bit wonky. You know I have to. As we talk about the bond market, still kind of unchanged at the moment. I believe closed over in London as well. There's a chart that I think is really important, which is the 2s10s inversion relative to the bank index. As we talk about those recession calls getting louder and louder for 2023, the inversion in the 2s10s is likely to get deeper and deeper. At least that's the story from a lot of bond strategists. And as it does, you start to see the bank index, the stocks, think JP Morgan, Morgan Stanley, Bank of America, those stocks, because of the pressure you're going to see on the loans and the interest margin, those are actually dropping as well. So the potentially a little bit more pain for the financial sector in 2023. But of course, that's all dependent on what the bond market does.
All right, Kriti Gupta, not too wonky. I think that was an appropriate level of wonk.
I feel like being wonky is part of the job.
Yeah, right?
No need to apologize for that.
Yeah, she does her job well. She was talking about the banks, though, Matt, and it strikes me that we need to get through this last trading week of 2022. But 2 weeks into the new year, we're going to start earnings season again. Those big banks are going to be reporting, and their tells on the consumer are going to be fascinating to watch.
Absolutely. I mean, the questions, well, we know that bank deposits are still at a relatively high level, but personal savings has come down. So that could start to roll over. And then credit card debt is starting to climb as well. So as more consumers are running out of cash and putting stuff on plastic, that's not good heading into a recession.
Yeah, leveraging up to do all that Christmas shopping this season. Well, let's continue the banking conversation and the consumer one as well. Goldman Sachs is set to be cutting 8% of its workforce, or about 4,000 jobs, come January. This is as its consumer banking division struggles to be profitable, and after the bank had been steadily hiring since 2018 when David Solomon became CEO. Our very own Sonali Bostic here at Bloomberg got to sit down with him for an exclusive interview less than 3 weeks before rumors of the job cuts began circulating. Take a listen to what he said.
We're at a very uncertain time, given we're changing monetary and economic conditions very, very quickly. And that's certainly having an impact of slowing down economic activity. And so if you're running a big financial services firm, I think you have to assume that we have some bumpy times ahead, and you have to be a little bit more cautious with your financial resources, with your sizing and the footprint of the organization. I think you have to expect that activity levels are going to be more constrained in a tougher economic environment. So we have businesses that are very, very correlated to economic growth in the world, and we're predicting economic growth will slow. Our economists predict 1.9% economic growth around the world in 2023, which is obviously slowing growth. And the big question is, as central banks tighten monetary conditions and try to control inflation, can they do that and orchestrate some sort of a soft landing? And I think that's still uncertain. I think there's a possibility of that, but I certainly think we could see a recession in 2023 also. And so I think you've got to be cautious and prepare.
How then do you prepare your staff around all of this? It's December, it's the end of the year. People are worried about jobs. People are thinking about jobs. They're thinking about pay as well. It's bonus season coming up. We've reported that you are even thinking about having lower bonuses at businesses that will have rising revenue this year. How are you thinking about this? Bring us inside your decision-making process and what you're telling your staff right now.
Well, we operate a business where every single year we have to pay our most important asset, which is our people. It shouldn't be surprising to people watching the performance of the business this year that 2021 was an exceptional year. It was a record year for the firm. It was the highest net revenue year ever for the firm. 2022 is a different year, and so naturally, compensation will be lower. We're still early in the process of making those decisions, but just like every year, we pay for performance, and we will pay people based on the overall performance of the firm, and especially for our senior people, we consider the overall performance of the firm as we go through our compensation process.
How do you balance also, this year you'd reintroduced the natural culling of headcount. The bonus discussion is not just here, it's obviously everywhere on Wall Street. How do you balance that with kind of the story that we saw just a year ago, this talent war that we saw, this booming market for people, and what's happening this year going into next year into tougher times? How do you balance retention as well as those more difficult conversations?
Well, we take a very long-term view with everything we do. And you have to adjust to the environment, and so you make changes around the margin. But at the same point, you take a long-term view, and you try to think about your business over time. We're extremely focused on serving our clients and our core businesses. Our clients have been active, and so it's important for us to strike the right balance in protecting our franchise and making sure that our people are paid for performance. On the other hand, we're in an environment that's a tougher environment broadly. Performance is not as strong, and so we balance that. But we take a long-term view. Our people take a long-term view. But I just made some comments in the Financial Services Forum where I said that I'm surprised by how resilient the competition for talent is. And by the way, this is just not in our industry. You're seeing across the United States and around the world that labor is still relatively tight.
Talent war is not over.
The talent war is I think there's some headwinds given we're changing economic conditions, but the competition for talent is still very, very strong. Now, how that evolves in 2023 is unknown. Certainly, if we have a slower economic environment, it will have an effect. You can see across all industries, not just tech, that people are thinking about their headcount size and they're making, let's say, pruning cuts or adjustments just because they feel more margin pressure coming. So financial services is not immune to that, and I think we all have to watch the environment and make the right long-term decisions for our organizations and for our shareholders.
Whether it's headcount or otherwise, as you think about this kind of tougher economic environment, the uncertainty, do you think Goldman is going to have to pursue another round of cost cuts in any fashion? And if that were to be the case, where could you see them?
Well, we always look at the environment and we always size the firm to the environment. If the environment gets tougher, we will obviously make decisions to size the footprint of the firm appropriately. That can come from slowing down hiring, which we've already done considerably in the second half of the year. And that might also come from pruning in certain areas.
So switching gears a little bit here, kind of broader financial services picture and talent war and whatnot. Last year, fintech, crypto firms booming. I'm curious whether the collapse of FTX is making you think in any fashion differently about crypto as an industry and the ability to potentially invest in some firms, maybe buy some assets here.
Well, I've been very clear on my view around this space. I think the underlying technology of blockchain is extremely interesting. I think there are enormous opportunities for blockchain to play a role in evolving the infrastructure of our financial system. I think there's an enormous amount of friction in the way money moves. I think there are a variety of ways that this technology can be used to allow more participation and inclusive participation in financial activities. I think it can break down barriers. That has nothing to do with Bitcoin or a cryptocurrency. I don't really, offer a view on cryptocurrencies. I think they're highly speculative. They may hold value, they may not. But I'm interested in the underlying technology and how the underlying technology can help serve our clients, our customers, and really take friction out of the financial system and also help make it more accessible.
Goldman Sachs CEO David Solomon there talking to star reporter Shonali Bassick. Great interview covering a lot of ground there, Kailey. Obviously, crypto is what piques our interest because we have a weekly crypto show and we've been covering these events all year long. What a year 2022 was for cryptocurrency on the way down. We just saw so many blow-ups and bankruptcies and kind of FTX, I guess, the icing on the cake in a sense, although very bad for those who had money on the exchange. Oh, absolutely. I mean, we're talking about billions of dollars that just evaporated or, you know,
rather were transferred to Alameda and then evaporated, Matt. But it is definitely a year that has shaken the industry to the core, because it was just, as you say, episode after episode. You had Terra and then Three Arrows, then ultimately the collapse of FTX. It raises a question of how you do the rebuilding, not just in terms of actually stabilizing some of the players in the market, but frankly, just rebuilding trust on Capitol Hill, where Sam Bankman-Fried himself had an incredible amount of influence over regulators and lawmakers who frankly got burned by what is alleged fraud. That the United States, the Department of Justice, is alleging this fraud. So it raises a question of where we go from here. Obviously,
very
that is
lightly
something
burned, right? Nobody really.
Well, if you took
Nobody really
campaign
took a hit.
donations from him, there is a bit of reputational damage there as well. But yes, I think it's more if you lend someone your ear and you are listening to their recommendations. We know Sam Bankman-Fried was pushing for the CFTC to have greater regulatory control over this space. Are you then less likely to go in that direction just because you now know that was a person that you perhaps should not have trusted?
One of the interesting things, most interesting arguments I've heard against regulation recently is the fact that if you regulate this space, opponents of cryptocurrencies are worried that you then give a certain degree of normalization to. You legitimize cryptocurrencies. Yeah. And so opponents of cryptocurrencies want the CFTC and the SEC and Congress to stay away from regulating it further. Nonetheless, there has to be some kind of regulation in terms of stable coins, especially if they're being used more and more. And many of the big banks have them as well. So that's one of the things that, for example, Isaac Boltanski tells us we're likely to see in 2023.
Yeah, it's a matter of putting in at least some safeguards, some level of consumer protection that, frankly, is quite lacking in this space. But you're right that there is that let it burn argument where it's just allow it to self-destruct. But it also raises a question of this did not bleed into broader financial markets. It definitely shook cryptocurrencies to their core, and we were obviously highly fascinated in it, but you didn't see any kind of real risk to financial stability. There was no contagion. If it is more closely integrated with traditional financial markets, that is when the real contagion could come through if you have an episode like this in the future.
It also doesn't really seem to have affected crypto that much. I mean, the FTX collapse.
Snooze fest. Bitcoin has become a snooze fest.
Bitcoin's still trading at 16,819.
Yeah.
Since Tom's not here, I can quote Bitcoin. $6,821 right now. And exactly, we haven't seen any volatility since the demise of FTX.com. S&P futures right now up 0.5%. Euro dollar trading at 106.48, and the U.S. 10-year yield at 377.14. Dan Ives joins us later on in the program, senior equity research analyst at Wedbush, to talk about the crash of big tech, which mirrors the collapse in cryptocurrencies. Stay with us for that. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. President Biden has declared a state of emergency in New York, where a massive storm dumped more than 4 feet of snow on the city of Buffalo. At least 28 people have died in the region. Meanwhile, Southwest Airlines is still struggling with the nationwide effects of the storm. It cancelled almost 3,000 flights Monday. The carrier expects the chaos to last a few more days. Taiwan is sending a signal to the U.S. and China that it's serious about defending itself. President Tsai Ing-wen is extending compulsory military service for men from 4 months to 1 year. Taiwan has been working with the U.S. to strengthen its defenses against a potential Chinese invasion. In Ukraine, the foreign minister is calling for a peace summit at the United Nations within 2 months. But Dmytro Kuleba tells the Associated Press he doesn't expect Russia to take part. Kuleba says Moscow must face a war crimes tribunal before Ukraine engages in direct talks. A UN spokesperson says that Secretary General Antonio Guterres can mediate, but only if all parties want him to. And Peloton has begun selling refurbished bikes at discounts at up to $500 below new model prices. The bikes will cost anywhere from about $1,100 to $2,000. Last month, Peloton disappointed investors with a lower than expected holiday forecast. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
our baseline is that the U.S. economy will avoid recession. We're going to go into a very sort of below potential growth rate scenario. We need to be humble. Right now, the labor market is very tight. The Fed is not going to back off in its inflation fight because inflation is just, way above where it needs to be.
Rubeela Farooqui there, high-frequency economics chief U.S. economist, talking about what to expect from the Fed. Of course, the Fed has had a huge impact on the stock market this year, and I can't help but think about Elon Musk using the Fed as an excuse for the underperformance of Tesla relative to the rest of the market, but it's also underperformed relative to other car makers. So
it's been brutalized, frankly, this year. It was a $1 trillion company at the start of the year. Now it is worth, $388 billion? So it has lost $600 billion off of its market cap. Those losses are continuing in pre-market trading this morning. The stock's down nearly 6% before the bell. And yes, I'm sure some of that can be attributed to just the broader weakness we have seen in technology. The fact that borrowing costs have moved up, it hits those higher multiple companies. But part of that is fundamental. There are questions about the Chinese market and demand there. And Elon Musk also, over the course of this year, granted it took most of the year to do it, but he did buy Twitter and seemed to direct a lot of his attention there. So
and overpaid.
And
by his
overpaid
own
at $44 billion, something, yes, he has admitted to. And that has maybe taken away from his focus on other companies he runs, like Tesla. So there's a certain degree of key man risk we have to consider with that stock as well.
And he continually seems to step in it, right? He really
doubles down, it seems.
Yeah, he seems to make problems for himself, and certainly for his investors as well. Let's talk to one of his, supporters and also opponents in some senses. Dan Ives joins us right now, managing director and senior equity research analyst at Wedbush. And Dan, you've been very successful with your views on Tesla and Elon Musk for many years. This year, everything seemed to go off the rails. What do you think happened with Musk and Tesla, and can he, bring it back?
Yeah, I think it was a Ted Stryker moment for Musk. And when we look at the Twitter situation, that's been a train wreck that's actually gotten worse, not better. And just like you were talking about, he's almost doubled down. And that's been a black eye for Musk, a black eye for Tesla. I think brand deterioration and then using Tesla as his own personal ATM machine, that's been a big issue in terms of for the stock in what's already obviously is a jittery macro.
Stryker, Ted Stryker, for those of you who are too young to know.
I just Googled it.
Is the main character in the film Airplane, which you have no excuse for not seeing. In any case, is there a possibility that Musk goes back to Tesla and somehow brings the valuation of his formerly $1 trillion company back to where it was? I hear a number of people saying it should be, obviously tech bulls, valued at $3 trillion. Do you agree?
Look, I think this could be course corrected. I think it's a step process. I mean, first thing is hands-off approach from Twitter, getting a CEO that's not just a figurehead. I think that's one thing that's important. Then it's boy that cried wolf, making sure no more stock sales and actually not just talking talk, but walking the walk. When it comes to Tesla, clearly there's some demand issues as we're seeing happen in China and globally. And after what's been a Cinderella ride, they're seeing some softness. But the overall EV story doesn't change over the next 4 or 5 years. So I do believe this is a stock that could regain its footing, but about 70-80% of it is Musk, Twitter, self-inflicted. So that's why that's a big piece of now sort of navigate through this storm and for the stock to ultimately see as lows.
Yeah, of course, Musk has said he's going to step back from being the chief twit at Twitter as soon as he finds a replacement. I guess it's just a question of when that happens. But Dan, you were talking about there of the fact that we have seen a lot of deterioration in the values of tech companies really across the board. When we think about the other mega caps, the Apples, Microsofts of the world, they all also have lost 30% plus this year. How quickly can that story turn around if we are still talking about a higher rate environment for longer after living in a world of zero rates for so long and these companies being able to enjoy free money and low borrowing costs and rich valuations?
Yeah, I think that's why it makes this almost a Game of Thrones battle between bulls and bears on big tech. I mean, our view is that big tech, ultimately is really oversold here. I think In terms of some of the fundamentals, I believe that we'll be able to navigate this macro a lot better than the street's anticipating. But ultimately, it is Fed-driven. It's 10-year driven. Risk assets essentially been thrown out the window. But our view is that tech's oversold here. And I think they will ultimately be able to regain the footing, despite obviously many yelling fire in a crowded theater here going 2023.
I would like to state for the record that that was a reference I did understand, Matt, because I have watched Game of Thrones, and I'll go home and watch
But you
Airplane.
haven't seen, have you not seen Airplane?
Matt, I haven't seen
Surely you can't be serious.
90% of the movies you've asked me about.
Wow, but this one is, I mean, it's a classic.
Okay, well, I'll add it to my list. I have a very long list of these movies.
Dan, a lot of people have been telling us this year is going to be, there will be a bifurcation, to use an overused surveillance term, in terms of the winners and losers. Do you think that's true? Do we get back to fundamental analysis? Are themes out the window for 2023?
I would say themes are out the window, but I do think that there's going to be a fork in the road, a stock picker's market in terms of tech. I think a lot of the enterprise names, cloud, cybersecurity, I think those are going to hold up a lot better in terms of just some of the trends that we're seeing in some of the fundamentals, but also in terms of management teams. I mean, never underestimate just how bad a management team could be and overestimate how good they could be. And I think that's something that's going to play out, especially in these types of, macros with some dark storm clouds clearly coming to the global economy.
So if it's time for stock picking, Dan, pick your stocks. What are your favorite?
I think in cloud, Microsoft, that continues to be our core cloud name here that we be buying, along with Salesforce, where I believe Activision is going to continue to increase. And those are two names that I really focus on. And then Apple continues to be our top pick. Remember, it's this supply-driven issue coming out of China, not demand. Demand's outstripping supply 3-1 here. We have some under-the-radar names like a Ziff Davis, a Nice Systems, and I think another name would be Planet Labs in terms of ways to play space. And I think there's going to be a significant amount of M&A that's going to come here, tidal wave of M&A. And right now, I mean, tech back against the wall. But I believe we sit here a year from now and much more green screens than red, given, I think, the setup going into this next year.
Overall, Apple is your favorite pick. Why Apple? What do we get new in 2023 from this company?
Well, I mean, first off, I think demand continues to hold up well. I think 3-1 demand over supply in terms of iPhones going into holidays and into next year. I think it's finally the Drummond and Gurman and others have talked about Bloomberg. I think Apple Glass finally comes out. That's the AR, VR headset we believe comes out potentially this summer. And the reason you want to own Apple, there's 2 billion reasons. It's that install base. That's the golden install base Cupertino has and no other company does. And despite right now, the haters, continue to hate on Apple, I believe in the stock that, we believe has 40-50% upside here.
Dan, thanks so much for joining us. Great to get your insights at the end of this year. Hopefully get you to kick off 2023 as well. Dan Ives there, a big tech bull from Wedbush. Appreciate, as always, his insights there. In terms of the markets right now, we're looking at gains. Kailey did mention Tesla trading down about 6% in the pre-market, so it's not among those. But the broader market is up. S&P futures up about 0.5% right now. And we're looking at investors selling 10-year bonds right now, so those yields are rising to 377. We're still well under 4,000, which was the year-end target for the strategists that we surveyed throughout 2022. As Kailey mentioned, the target started at 4,900, but it's crept down to about 4,000. We had the same target for 2023 as well. So it doesn't seem that strategists on the street, Kailey, are really that optimistic for any kind of recovery next year.
Yeah, well, I think it's more that they think there's going to be more downsides to come. So when you get a recovery from the actual depths of this bear market, it's only going to bring us essentially back to where we are now. So potentially limited upside and potentially limited upside as well for the rest of the year. There's only 4 trading days left. And of course, you and I are working, Matt, but most people aren't this week. I just took a look at volume on the Stock 600 right now, 70% below the 20-day average. So we have to keep that caveat in mind when we look at the market moves today and, frankly, throughout the week.
Right. And, of course, we do have no trading in the UK today. It's still a holiday there, but they're still open in the Netherlands, in France, in Spain, in Germany, in Italy. So the rest of the continent up and running. We're going to talk to someone next who says we'll be lucky if 3,500 is as low as we go in 2023. 2023 on the S&P. Matt Mailey joins us, chief market strategist at Miller Kailey, to give us his take on valuations. This is Bloomberg.
The economy's resilience is pretty clear by the economic data.
It'll become more noticeable that the rate of inflation is slowing.
We do expect to see positive returns in investment-grade credit in 2023.
The fact that we anticipate stronger infrastructure spending can make a significant difference in terms of growth rate.
The market thinks they're going to start cutting rates this year, where the Fed has made it pretty much clear that they're not going to be cutting rates this year.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Welcome to the last trading week of 2022 from New York City. For our audience worldwide, good morning. This is Bloomberg Surveillance on both Bloomberg Television and radio. I'm Kailey Leinz alongside Matt Miller. Tom, John, and Lisa are off for this holiday week. Matt, they are missing the final 4 trading days of the year. But barring something insane happening over the course of the next 4 days, this is still going to be the worst year for the U.S. equity market going back to 2008.
Yeah, it's been a rough year. Obviously, the reason is the Fed continues to hike rates. They've added more than 400 basis points so far this year, and it doesn't look like they're set to stop anytime soon. At some point, of course, they will plateau, but they may not pivot as the market has hoped so often throughout 2022, and that's one of the big problems, right? We've been in a bear market, and we get these little rallies every time the market thinks the Fed is going to back off. They don't do it, and then it brings us back down again. So it looks like we could go to 4,000, but we're under that right now at 38 and change. Futures are up a little bit right now, but it's going to take a few hundred points to get us up to year-end targets, and we are at the year-end now.
We are almost there. 38.83 right now, as Matt said, is where we trade in the future session. We are seeing risk sentiment lifted today by what the news was out of China, them essentially releasing or undoing the last of the COVID-0 restrictions, with those quarantine restrictions for inbound travelers being relaxed as of January 8th. So that lifted the Asian session, by extension the European session, and is lifting futures as well this morning. But we have to keep in mind, because it is a holiday week and the UK is still closed for an extended weekend, volume is going to be really, really light. That is factoring into the foreign exchange as well. The dollar is off of session lows, but still weaker against the euro at 106.31. And in the bond market, not too much movement on the 10-year yield. 377.52 is where we trade at the moment. But to bring it back to that China story, Matt, that is what you are seeing rippling across the commodities complex, with crude up about 0.5% today on WTI to around $80 a barrel. But other commodities like iron, palm oil, copper, all rallying on that China story.
And fish tickets.
Oh.
Do you know that we're going to kick off
the
this
most
week
prized commodity
a
of all?
4-day run, the traditional Madison Square Garden 4-day New Year's Eve run for fish, and I still haven't got a ticket yet. So if anybody has a Friday night ticket, please email me. Anything could happen. Anything could happen this year.
Is this like a Taylor Swift type scenario? I mean, what are the price tags on these things?
No, I think we're looking at much less money than Taylor Swift, because the kids don't really care that much about fish, right? But I think Wall Street maybe could care.
Okay, and this is fish PH.
PHISH. Yeah, they play every year at Madison Square Garden. Last year they had to push to April, and then everybody got COVID, but hopefully this year will be a little bit safer.
Okay, well, let's see if Matt Mailey of Miller Kailey is going to fish. He is the chief market strategist over there and is joining us on this Tuesday morning. Matt, thank you so much for being here. First things first, fish fan? Yes, no?
A fish fan, but I will not be attending any of the concerts here this year, I'm afraid. I won't be able to make it down. But
okay, well, the attendance that matters is your attendance here on Surveillance this morning. So let's get to the actual pertinent market conversation. Matt was talking about how 4,000 became the consensus. We may or may not actually reach that level this year, but obviously that was after expectations had to be dramatically reduced from what they were at the start of 2022, what we expected this year would bring. Does that mean that expectations for 2023 are also perhaps overly optimistic?
Well, I mean, it's funny because one of the things is that we have heard a lot of bearishness around the street in the last couple of weeks, which is, the sentiment has changed dramatically. But you're right. Even though people have become much more bearish, they're talking about things dipping further. They think, well, don't worry, by the end of the year, it'll be fine. I'm a little concerned about that. I mean, I do think the worst, won't happen by the end of the year. It'll happen somewhere in the middle of the year. But the biggest problem I think that we face is that whenever the market gets to an extremely overvalued level, like it did at the end of 2021, this time last year, the bear market always lasts longer than just a year or so. It usually lasts 18 months or even a little bit longer. That's number one. Number two is that the valuation levels, again, when you get to extreme valuation levels that we have, it takes a lot bigger decline for the market to get back in line with what would be a natural level of valuations.
Okay, and what is that, Matt?
So much must have reached the bottom, but I don't think that's the case yet.
Give us some numbers.
Yeah, what is fair value in a world of now 4.5% interest rates instead of 0%?
Well, that's the thing. We have, well, to give you a number, at least 3,500, and that's assuming we don't have a recession. That's assuming we don't get a decline in earnings in 2022. And every bear market and every recession since World War II has given, every recession, not every bear market, but every recession since World War II has given us a decline in earnings. So if we have a decline in earnings next year, that takes us, again, something below 3,500. People have to forget that people have to remember, that when you don't have zero interest rates and you don't have QE, you don't have 18 to 20 times forward earnings. You have something more like 15 to 16 times forward earnings. That's the fair value.
So do we need then to come down? I'm interested really in the PEs, the valuations, because it's something I actually understand. So you look at forward PEs, right, and we're trading at 17.3 right now. Do we need to come down to 15 before this bear market can end? Is that also something that we've seen in every bear market?
Exactly. Every single bear market since basically since World War II, certainly over the last 40 years, you've seen at least 15 times forward earnings, if not lower. But that's the very best we've done is 15 times earnings. And again, when you get to all these all-time valuation levels, we certainly had it, extreme valuations in 2007 and in 2000, the very beginning of 2000. The problem is you get all this addition of leverage. And so when the de-risking process and the deleveraging process takes longer than just 1 year, and people think, oh, Jesus, come down so much, that's enough. It's like, actually not, until we get those valuation levels, because the leverage gets so far to one side, it has to swing to the other one as people deleverage, and they have to, I hate to say it, but they get forced selling. They sell even though they've reached fairly value. They sell because even when they don't have to, because they're getting margin calls and such, and that's why the market swings to the other direction. It's not just a thing. There's an actual reason why we get a swing to the other extreme, and so we'll probably get something below 15 times earnings before we actually bottom.
So how long will it take? I always think of the age of deleveraging by Gary Schilling, which was a financial crisis thing, right? It took us a decade to get through that. Are we looking at that kind of leverage again, or is it not nearly as serious so we could be done with it in 2023, the deleveraging that is?
Well, it certainly could happen, bottom out in 2023, but I just think it happens at a lower level. I guess the question is, how much does the Fed willing to let it deleveraging take place? What I always point back to is 2018. Everybody says, oh, geez, the stock market started to crumble so bad that the Fed was forced to pivot. Well, it wasn't the stock market. They actually, in the middle of December of that year, right in the middle, they said, hey, the market's down a lot. We don't care. We're going to keep tightening. Then 2 to 3 weeks later, the fixed income market, the junk bond market just imploded. And that's when they pivoted. So they're much more concerned about what's going on in the fixed income market. And right now, even though it's down quite a bit, it's still running fine. So we may get a pivot later on this year from the Federal Reserve where they actually start cutting rates. But that's going to happen when the situation is going to become much more dire than it is now. If we just have this slow grind lower, the Fed's going to keep interest rates at high levels, even if they stop raising rates in any kind of way.
Matt, finally, well, none of us probably could have seen what the Fed did this year coming at the start of it. We couldn't have seen the war in Ukraine, so many things. I think also many of us weren't anticipating that in 2022 we would see essentially the full reopening of the Chinese economy. Many of us thought it was just something that was going to take much longer. If you have unleashing of commodity demand from China, how does that fuel back into those prices and, frankly, the energy sector, which has already run so far this year? How much more upside could there be?
Well, I think that it can't be more upside. I mean, as you say, with China reopening, you see the commodities bouncing back, and that could continue, especially if the dollar continues to move lower. If there's one thing that we've been a good correlation or an inverse correlation has been the dollar, and over time has been the dollar and commodity prices, especially with oil and gold for that matter. But the thing is, though, is that if you look at the way the valuations are trading for the energy sector, it's still trading for oil trading at like $60, $65. And it seems like OPEC wants to keep it at $70 or higher. And now with the reopening of China, we could get pushed back towards the $100 level. That's going to be bullish for these equities. They still have, believe it or not, they still have a ways to go to play catch up to the price of oil, even though it's rallied, even though they've rallied so much this year. So I still remain bullish on the energy sector throughout most of this year.
All right, Matt, thanks so much for joining us. Matt Maley there of Miller Tabak. He has been bullish on the energy sector, and if you ever decide to cash out of some of those deals, we can buy some nosebleed seats at Madison Square Garden, and we'll stub down to the floor for the Fish Show this New Year's Eve. Coming up, Dr. Bhakti Hansadi, Associate Professor of Emergency Medicine at Johns Hopkins, is going to talk to us. This is important because when I went to the New Year's Eve run in April at MSG, I got COVID. So did almost everybody else in the garden. Even 3 out of 4 members of Fish got COVID. And now it looks like it's coming back, right?
Yeah. Anecdotally, I know like 5 people who have COVID right now. It disrupted some of my family's Christmas plans. And if it's not COVID, there's just a lot of other people who are sick, whether it's the flu or something else. Even my dog has canine influenza right now. So if we could all send Grant,
poor Grant,
the Silver Labrador, our best wishes.
All right. Well, we'll talk to the doctor about this rebound in COVID infections and how it could affect your New Year's Eve celebrations when we come back. This is Bloomberg Surveillance. We are simulcast on television and radio.
We should play Fish.
We should.
Everyone.
We'll play it during the break. Good morning.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. China is reopening its borders to the world by removing the final COVID-0 restrictions. Starting January the 8th, Beijing will no longer require inbound travelers to quarantine. They'll only have to obtain a negative COVID test within 48 hours. Meanwhile, the Chinese government may also reduce the frequency of reporting cases, ultimately changing to a monthly report. In western New York, at least 28 people are dead in one of the worst weather disasters ever to hit the region. More than 4 feet of snow fell out of the city of Buffalo. Cars were buried in snow drifts, and emergency crews could not respond in time to medical crises. President Biden has offered federal assistance. Meanwhile, Southwest Airlines expects that the chaos caused by that storm in the U.S. will last for another few days. CEO Bob Jordan told the Wall Street Journal the carrier expects to operate just over 1/3 of its typical schedule so it can get crews in the right positions. Southwest canceled almost 3,000 flights on Monday. In South Korea, the military says it sent drones across the border into North Korea for the first time. It's an unprecedented move that followed North Korea's decision to send 5 unmanned aerial vehicles into South Korean airspace. North Korea's leader, Kim Jong-un, just opened a major political meeting to set security, economic and political policy. Despite well-publicized layoffs in the tech industry, most of the workers affected are finding new jobs quickly. That's according to a survey by ZipRecruiter quoted in the Wall Street Journal. The survey says about 79% of those hired after losing jobs at a tech company found new jobs within 3 months. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
They've raised their inflation forecast.
Firm and immediate action.
He wants to destroy my country.
Elon Musk to buy Twitter.
Overturned Roe versus Wade.
Boris Johnson will call it
Donald
quits.
Trump's plan to overturn the
Unprecedented
election.
search warrant at the home of our former
Queen
president.
Elizabeth has died.
Xi Jinping got his third consecutive term. Pound falls to an all-time low.
The shortest ever serving prime minister.
Presidents Biden and Xi shake hands.
FTX filed for bankruptcy.
The red wave that never was.
Protesting his zero COVID policy.
We think we might skirt a recession, or if we do a recession, it'll be relatively light. The economy's resilience is pretty clear by the economic data. There's a lot of opportunity for positive surprises.
That was John Stoltzfus, Oppenheimer Asset Management Chief Investment Strategist. This is Bloomberg Surveillance. Welcome back. I'm Kailey Leinz, alongside Matt Miller, filling in for Tom, John, and Lisa, who all have this in-between holiday. Do we call it a holiday week?
I guess it's a holiday week. No, because yesterday was Boxing Day.
Right.
And
today's
we're coming
still
up
something
on
in
New
the
Year's
UK.
Eve.
We are.
Today is just a bank holiday in the UK, right? They just give that because Christmas was on a Sunday, and they expect 2 days off for Christmas and Boxing Day. They extend it. I think it's the right thing to do. It seems civilized.
Yeah, I'd like that very much. But of course, what that means when you have the UK still offline is that volume is very, very low. So we have to keep that in mind when we take a look at the market action today. But by and large, the market action has been positive, at least to this point in the future session, although we have seen the gains getting smaller as time has gone on. The NASDAQ 100 futures actually now up about 0.1%. Bigger gains, though, for the S&P 500 futures up about 0.4 to 38.86, which, Matt, as we've discussed multiple times already in the last couple of hours, is far below where we initially thought we would end the year, and still below where strategists had revised lower their expectations to. Yeah, we need to see a rally in the next few days of about 4 or 5% before we can get back to, before we can achieve strategists' median target for the year end, which is a bit over 4,000. And then all the strategists that we've surveyed, or most of them, as a group, let's say, expect us to drop down. We just heard Matt Maley at Miller Tabak say 3,500 would be like a good drop. Right. We could drop below that and then recover at the end of 2023. So we're in for a bumpy ride, I guess, at the beginning of the year is what a lot of people are saying. Yeah, and of course, it's been a bumpy ride in commodities as well, as the concerns about supply have been replaced with concerns about demand. Now commodity markets, at least this morning, seem to be being driven by the China story, as China has now released its economy essentially to the forces of COVID, removing some of the last remaining COVID-0 restrictions, abandoning the quarantine requirement for inbound travelers. But we know that cases are now surging in the country as a result. Let's bring in Dr. Bhakti Hansati. She is Associate Professor of Emergency Medicine at Johns Hopkins. Great to see you. It has been a while since we've spoken. If we could just think about China in particular in terms of the remaining COVID story, what is your expectation for what is going to happen there, given the vaccination rates that they have, given now that there's been basically an entire removal of restrictions? When could China reach a peak in cases?
I think it's really hard to answer your question, when can they reach a peak? Because we just don't have accurate reporting data from the National Health Commission. China stopped reporting cases. We're reliant on the China CDC, who traditionally does monthly reporting. And we have not seen numbers coming out of China. So when can they get a peak? I honestly don't know. But what we're seeing is that there's been a rapid surge, similar to the Delta and the Omicron waves. In most countries, when we went through Delta and Omicron, we saw a peak at 6 weeks. So I'm praying for them that this is fast and rapid and resolves soon. We also do know that China has high vaccination rates, with over 90.2% of individuals fully vaccinated. And we have also heard that Chinese have access to oral antivirals that will decrease hospitalizations and deaths. So, they are similar to the US in that there is innate immune protection available to individuals, and that we know that they're likely sick with the newer variants, which have a much more transmissible, and so much more likely to peak early.
So this newer variant, it's not Delta, it's not Omicron. Do we have a new name for it? And what else do we know about it besides the transmissibility?
We have numbers and letters, so we have moved away from names. We have BA 1.1, BA 5, BA 5.1's Q. So we know in transmissive, I know, right? but we ran out of names a long time ago. So we know that in terms of transmissibility, within 2 to 3 days of individuals coming in contact with someone that's COVID positive, that they'll be symptomatic. We know that at 5 days, individuals will get sicker, requiring hospitalization and needing therapeutic treatment. We know that as quickly as it comes on, it goes off. So individuals are most likely to be symptom-free within 10 days.
I don't want to wear a mask. Do we have to wear masks again? I don't think I'm going to.
It depends who you are, right? I don't know you, but if I did know you and I knew you were immunocompromised or you had a disease that made you vulnerable to getting really, really sick from COVID, or you were an individual in whom the oral antivirals were unavailable, I would say wear a mask. I will say, though, wearing a mask is tough. We are exhausted as a nation, and that you need to assess your own risk. And every American has agency to make those decisions.
I was speaking with Matt earlier about how so many people I know are sick right now. Some of them are COVID positive. It seems like I know more COVID positive people than I have in probably a year. But there are also a number of people who are just ill, whether that's the flu or sinus infections. I myself feel like I have been getting sick way more often than I ever did pre-pandemic. I'm just wondering, like, long-term health ramifications. If people are getting more sick, whether because that we've suppressed our immune systems by wearing masks and not interacting with people, and we're getting are we going to be more sick more often, especially now that COVID is probably going to be circulating in the population for some time to come as a seasonal virus?
Maybe, Doc, you can solve something that an argument that we have at the Miller household. My wife wears masks all the time and constantly, what do you call this?
Washing your hands?
No, not wash. She's using this
hand sanitizer.
This hand sanitizer all the time, right? Like, it's an addiction. I never use it and don't wear masks. I never get sick, and she constantly does. Have people who are overprotective of their immune systems allowed them to weaken so that they get sick so much, or is this just coincidence in my anecdotal home life?
So again, no easy answers here. And in my household, we joke, I've had more viruses than pumpkin spice lattes, but I'm the mom of 2 young kids. I have a 5-year-old and a 2-year-old, right? And they're bringing stuff from home. So I think what's really going on here is, yes, we have not been as exposed in the last 2 years as we should have been to common household colds, to different enteroviruses, coronaviruses, and colds. Also, however, if you look at the current strains of RSV and flu, they are more virulent than they have been previously. This happens with the flu. Every 5 to 7 years, you get a flu variant that is more aggressive than previous. So I think it's a combination of two, right? Last year, we weren't exposed. We don't have any immunity. On top of that, we have a flu and an RSV season that is also hitting us really hard. Are we about to become a nation that's constantly sick? I don't think so. Does your wife have a weaker immune system compared to you? Probably not. She's probably just exposed. Maybe she's at home looking after kids. Maybe she's out there doing things in the community, going grocery shopping. And you are in the studio and you're more protected. I think it all depends on what our lives look like and what our exposures are, and thus what we are likely to be afflicted with.
All right, Doc, thanks so much for joining us. Pleasure talking to you again, although hopefully it's not too often, right? Because when we're all healthier, we see you less often. Dr. Bhakti Hansadi there of Johns Hopkins talking to us about this, this wave that we're seeing. And it's, I don't think it's anecdotal, right? We have the data to back up that we really do see it coming back in a pretty serious way. And hopefully it's just more transmissible and not as fatal.
What I think is interesting, though, with this wave that maybe is different is there isn't much of a push on vaccines and boosters as there was before.
Well, how many more vaccines and boosters can I get? I'm on 5 already.
You're supposed to continually get boosted after your initial boosters to continue.
But we do that.
Keep up your...
I think we do that. No one needs to push us, right?
Well, they needed pushes initially big time. There was big government effort to get people vaccinated and a lot of outreach around that. And I feel like that part of the conversation has just diminished somewhat. But coming up, we're going to continue our conversation on these markets as we do see futures moving higher to start this last trading week of the year. Right now, S&P 500 futures up about 0.5% at just shy of 3,900. The 10-year yield at 3.78. This is Bloomberg. Welcome to a special holiday week edition of Bloomberg Surveillance. Kailey Leinz and Matt Miller in, Tom, John, and Lisa all on a well-deserved holiday break on what is a shortened trading week and one that is a little bit light on the events, Matt. We don't have too much big economic data or big catalyst events happening in the next 4 days, but we are going to get those small incremental data updates today in just a couple of moments and throughout the week as well. The first one being advanced goods trade balance for the month of November, coming in at negative $83 billion. That is actually less than the estimate.
It's true. It's less bad than the estimate, right? We were looking for negative 96.7 billion. We got negative 83.3 billion. The trade balance, it's interesting. It's something we always pay attention to on holiday weeks when there's nothing else to talk about.
Okay, well, this one might actually be more interesting then. Wholesale inventories, this is the preliminary read for the month of November, a month-on-month figure, actually up 1%. The estimate was only for up about 0.3%. So interesting to see that kind of inventory build, which is a story we have been following for some time now.
Ever since Cathie Wood said inventories are going to lead to deflation.
Right.
She said we were already in a deflationary cycle.
Yes, and we can talk about the merits of that argument, but we have seen this borne out to a certain extent. We are just coming off of the holiday shopping season in which there were actually discounts this year if you wanted to buy presents or if you're hitting the after Christmas sales, because retailers have to work down that inventory and they're cutting prices to do so. So there's your economic data. Let's get you a check now on the markets. Bloomberg's Kriti Gupta is here for that.
Yeah, well, Kailey, off the economic data, no major moves when it comes to the markets. But I will say in the last hour or so, you have seen a bid, or I should say a little bit of a pairing of the gains that we saw. So we are still seeing green on the screen when it comes to the equity market. But now futures are up only 0.4% relative to almost 0.6% earlier in the session. Something you're seeing in Russell 2000 futures as well. That real outperformance starting to slow down as we get closer and closer to those opening bells. And over in Europe, it is still the same story. Green on the screen, kind of unaffected, but there is one culprit that's leading to these really marginal small moves, but moves nonetheless, and that is the dollar, which is actually starting to see a little bit of a bid. Look, it's still negative on the day when you look at the Bloomberg Dollar Index, but it is climbing. It is pairing some of those losses. So the ripple effects are really crucial, not just in the equity market, which I just pointed out, but in the currency market. Of course, the euro really benefiting, or I should say reversing some of its moves. It's now down about 0.1%, but the commodity complex as well, also pairing its original gains. You're seeing copper only up 2% relative to almost a 3% gain about an hour ago, and Brent crude still trading with an 84 handle. So this idea here that the dollar moves are having this ripple effect, I think that's the takeaway about an hour away from the trading bell.
All right, Kriti Gupta with your macro picture. Thank you so much. Let's take a look at the micro picture now, and one company in particular, Uber. Its shares are down more than 40% so far this year, but the company's CEO, Dara Khosrowshahi, is optimistic about the future. He spoke to Bloomberg's Emily Chang.
I want to start with the bigger picture because I just interviewed Airbnb CEO Brian Chesky yesterday, and he told me he thinks a revolution is happening in the way we travel from business to leisure. Do you think a revolution is happening post-pandemic in the businesses that you run, rides and the way we order food, or will life revert?
Well, certainly there's a revolution happening in terms of delivery of all things to your home. It started with food, but it's going to continue with grocery and pharmacy or your iPhone, et cetera. And just in 4 years, our Uber Eats business has gone from a $2.5 billion run rate to a $52 billion run rate. And we think there's so much more to go. Users want what they want at their home right now. You know, it used to be that next day delivery was awesome. Now it's all about next hour delivery. And what we're doing is empowering any local merchant to essentially get anything that you want locally to your home within hours. And clearly eaters and users love it. And we think it's a trend that's going to continue over the next 5 to 10 years.
Now, you just revealed Uber could post its first profit this quarter. What are the levers that you can and will pull to determine whether that happens this quarter or not?
Well, I think what's happening now is our marketplace is becoming much more balanced. If you looked in Q2, the demand for moving around and getting things to your home essentially was increasing at a much faster rate than supply. We had to invest very aggressively to bring more drivers onto the platform, more couriers onto the platform. And you're seeing the benefits of that in Q3, where the marketplace is much more balanced. Our margins are coming back to normal. Our mobility margins actually are going to be equal to pre-pandemic levels, even at lower volume, because of the moves that we've made in terms of automation. And our Uber Eats business is both growing the top line, but now is getting to EBITDA profitability levels as well by the end of the year. So really now things are working out quite well for us, where we can grow the top line, but we can do so profitably on a sustainable basis for some period to come.
Still, you're continuing to work on driver supply around the world. There are price surges that we as riders are certainly feeling. You've said that price surge will ease up by the end of the year. Without that, do you see long-term profitability? Will you hit that milestone quarter after quarter?
Well, absolutely, we do. And we're seeing the prices essentially stabilize now. Our surge levels are coming down. ETAs now are the best that they've been since the beginning of the year. And conversion rates, as far as the percentage of users opening the app and getting the service that they want, whether it's food delivered to their home or whether it's they're going somewhere, all of these metrics are moving in the right direction. So we think we can be profitable, but we can be profitable delivering an amazing experience to riders and eaters, and also really strong earnings level to our earners.
I want to zoom into the UK in particular, where you are seeing longer wait times. Drivers are going to other apps. They're moving on to other sources of income. When do you see a better balance between supply and demand?
Well, I think what we're seeing in the UK is that demand right now in the UK is at 20 to 40% higher than pre-pandemic levels. I mean, the UK is really opening up, and it's amazing to see. The number of drivers that we have on our platform now is as high as it was pre-pandemic, but it hasn't caught up to the growth in supply. So we're going out there in the UK now, and we are looking to bring on 20,000 more drivers onto the platform. The earnings opportunities are better than they ever have been. And as far as the service goes, over 60% of the time you're getting your ride within 5 minutes. 90+% of the time you're getting your ride within 10 minutes. We want it to be faster, but the service is now working the way that we want it to, and there's a ton of earnings opportunities, and hopefully we'll get more drivers onto the platform to catch up to the incredible demand that we're seeing.
DoorDash's market cap briefly surpassed Uber's in the last week. The stock's back up, but it was kind of a close call. A former Uber executive called that a nightmare. He invoked a comparison to Yahoo. How do you respond to that?
Yeah, I think I wouldn't put a lot of credence into that particular former Uber executive. It was a point in time. The fact is, if you look at our volumes are twice as high as DoorDash's, and we're growing faster. Our revenue is 3 times larger than DoorDash, and we're growing faster. And based on third-party data in the U.S., our Uber Eats business is the fastest growing food delivery platform in the U.S. So we're very confident as to where we're going. And I think this is a point in time in terms of relative market caps that I don't think you're going to see again.
DoorDash is getting into alcohol delivery. Investors are betting they're going to be big in grocery. You did buy the grocery delivery company Corner Shop earlier this year. We saw that partnership with Albertsons. But when are we going to see your grocery efforts really scale up and bear fruit?
Well, I think it makes a lot of sense for DoorDash actually to follow us into alcohol delivery. We've been there for over a year. We have alcohol delivery now available on Eats in over 20 countries. So it makes a lot of sense for them to follow us there. As far as grocery goes, we have focused actually outside the U.S. first. We think we can be the winner in Latin America, which is Corner Shop's home turf, so to speak. We're aggressively expanding grocery in France, in UK, countries like Taiwan, Australia, etc. And in the U.S. now, we have a really strong tie-up with Albertsons and Costco, and we're going to essentially expand with the partners on a local basis.
Meantime, very important situation brewing in Texas. Uber and Lyft have said they'll pay the legal fees of drivers sued under this new Texas law banning abortions. You donated $1 million to Planned Parenthood. If other states pass similar laws, would we see you do this elsewhere? Does Uber support a woman's right to choose on a national level?
Yeah, we absolutely do. And I think more importantly, we don't think that drivers should be sued by private clients. We think that's unprecedented. It's wrong. And if it happens in another state, we're going to stand behind our drivers just like we did in Texas.
Meantime, Dara, your CTO stepped down, and you have made the unusual decision to become acting CTO. So you've got now these highly technical executives reporting into you. I'm so curious, how are you preparing for this new responsibility? That's a really critical job.
It is. You know, I was an engineer back in school, so I get to geek out now. And I think at Uber, we have the best technical capabilities in the space. And my working directly with our top engineers, we have an incredible bench. So, you know, I'm actually looking forward to it. We have a great bench that we're working with, and I think we can keep innovating, and I think we can keep shipping products faster than any of the other local players out there.
So speaking of some of your other bets, you recently made a visit to Joby. You watched one of their flying taxis take off. Of course, you've also got self-driving with Aurora playing out. How do you see these other bets on self-driving cars, flying taxis playing out? Is this the real travel revolution that we need to wait for?
Well, I think all of these technologies are happening. The pace at which they happen, I think, actually is going to depend a lot on the regulatory authorities. The Joby tech in terms of flight range, in terms of sound, is extraordinary. I got to experience it myself. And obviously the certification process is going to be the most important factor in bringing this technology to bear. And with Aurora as well, we're thrilled to be working with them both on the trucking side and the rideshare side. And I think it's about safety first, and the technology leaps that we're seeing there are super encouraging. So these are two best-of-breed teams, along with Lime, who is the leader in terms of e-bikes and scooters in the world, and we have strategic investments in each of these very important areas. And we love our investments because we made the investments in what we believe are the best teams and the leading teams in each area.
Dara Khosrowshahi there from Uber. Coming up on the Open, we're going to get back to rates as we watch the 10-year continue to climb. Right now at 381.28. Priya Misra joins us of TD Securities, Gerson Distenfeld of AllianceBernstein, Andrew Sliman of Morgan Stanley on the Open. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. President Biden has declared a state of emergency in New York, where a massive storm dumped more than 4 feet of snow on the city of Buffalo. At least 28 people have died in the region. Meanwhile, Southwest Airlines is still struggling with the nationwide effects of the storm. It canceled almost 3,000 flights Monday. The carrier expects the chaos to last a few more days. Taiwan is sending a signal to the U.S. and China that it's serious about defending itself. President Tsai Ing-wen is extending compulsory military service for men from 4 months to 1 year. Taiwan has been working with the U.S. to strengthen its defenses against a potential Chinese invasion. In Michigan today, a federal judge will sentence a man described as the driving force behind a plot to kidnap Governor Gretchen Whitmer before the 2020 election. Adam Fox could get a life sentence. FBI informants helped law enforcement break up the plot before it could be carried out. Fox's lawyers say he was manipulated by the informants. And Peloton has begun selling refurbished bikes at discounts up to $500 below new model prices. The bikes will cost anywhere from about $1,100 to $2,000. Last month, Peloton disappointed investors with a lower than expected holiday forecast. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
got the yield curves inverted like they are, the leading economic indicators acting as they are, and so many indicators would be historically unique to not go into recession. The worse the economy is now, the better the market can be, because the Fed will be able to lower rates even before renewed expectations.
Tony Dwyer, Canaccord Genuity Chief Market Strategist, speaking there. We are gearing up for the first trading day of the last trading week of 2022. And with just about 45 minutes to go until the opening bell, the picture is starting to get a little different and perhaps a little more exciting. We now have futures heading toward session lows. S&P 500 futures right now only up by about 0.1% at 38.73. And actually, NASDAQ 100 futures have now flipped into negative territory. They are down by about 0.2%. So some of the optimism around the China reopening story seems to be giving way to more pessimism as we look to close out what has been a brutal year for the U.S. equity market. We are still on pace for the worst year since 2008. Of course, a lot of that equity pain has been driven by the bond market, and we are getting more movement there as well. The 10-year yield up 7 basis points to 382, a big leg up after what we understand was a big futures block trade. But enough about the markets. I want to talk about football. I am still recovering from the loss of my Denver Broncos to the Rams on Christmas Day, but former Giants quarterback Eli Manning is jumping into a different venture, selling used sports apparel and getting in on private equity. Bloomberg News' Jason Kelly sat down with Manning and BVG's Steve Lebovitz to learn more about their first private equity deal and why it was so important to Manning to acquire and own a company.
Everyone knows Eli Manning, the quirky Giants quarterback, famous for a couple Super Bowl titles and also launching a whole lot of memes. But post-football, he's been on the rise in another business, private equity. I got to sit down with Eli and one of his PE partners, Steve Lebovitz, to discuss Eli's first big deal, and also that time he couldn't speak on the investment committee call because he was in the makeup chair to become Chad Powers. All right, so Eli, tell me about sports and private equity colliding. You're the manifestation of it. Like, how's this all working?
You know, it's a funny time right now where sports are almost becoming an asset class in investing and in different ways that you can just be involved in sports. And it doesn't have to be an ownership of a team, but just adjacent to the sports world, whether it's apparel, whether it's equipment, whether it's real estate or the fan experience. And so it's just an exciting time. Excited, you know, to kind of join the private equity world, but also the fact that kind of the first deal I ever did was in the sports world. Right. So it was a little easier for me to come in there, freely talk about it, and be passionate about what we were doing.
Steve, talk about this idea of Eli being this almost like canary in the coal mine for like athletes into private equity.
Athletes over time want to have more control over their brands. They want to have more control in general, not just be necessarily a paid spokesperson. That we think is a real trend. That, as well as thinking about private equity as opposed to venture, which historically, my partner Drew always says, you know, athletes are the mentality they want to create the next 3 unicorns, not just one. It's not good enough. With our companies and in private equity, sometimes they have the opportunity to grow the companies, but without the same risk profile of venture. So we think that should be appealing for athletes, and Eli, as you mentioned, is kind of on the forefront of that.
All right, so Eli, your first deal, it's a uniform company. Tell us about discovering it and working on it.
Since I joined BVG, this was kind of the first deal that we were looking to acquire, and it's a Score Sports is the name of it, and it's a designer, manufacturer, seller of youth sports uniforms. I was excited just because I love youth sports. I purchase a lot of uniforms and youth uniforms for my own kids, and so and this was interesting to me because it's vertically integrated and they do everything in-house. The price point is at a much lower level than some of these other uniform companies, and so you could get a full kit for $18 to $20 instead of a family having to pay $100 for uniforms. It was interesting for me just to learn the process of the private equity world, and I've pitched many products before but never pitched a company that I'm trying to encourage you or tell you why you might invest in this and give us money. And so being a part of this and how I can help grow this company, and from the marketing standpoint to the business management to the culture side of it are all the things I'm looking to get involved in.
Tell me about that pitch process, because one of the interesting things that it does, I think, is it brings you into contact with other former athletes as business people. So not looking across the line at them, not worried that they're going to knock your block off, but more the idea of saying, this is a deal I think you should do.
Well, obviously, I think when you're talking to athletes or former athletes and pitching an idea on youth sports, I think they all have a great appreciation of it. And the idea of getting kids, and a lot of the people that I went to, former athletes, they have kids. Their kids are playing sports. You understand it is a great business. It is growing. There's more sports available to more kids now, and it is a great deal. And a lot of these athletes wanted to not only invest, but thought they had connections and communities that they could help get this company involved in to help grow it.
That leads to a really interesting moment, it feels like, for the firm, where you're essentially validating something that you're seeing with Eli as a singular person, but then there's this network of people that you're already somewhat in touch with that then becomes a new business line in some ways. Tell us about that.
Yeah, no, we saw opportunity there, given our network and the connectivity there, and with sports being such a great industry, it's like $500 billion plus global industry. It made a lot of sense for us. We feel like with the folks we know, not just athletes, but with executives, top-notch ones who are involved with our group, we can cover like all the different aspects of a sports business. So we feel like we're really well equipped to offer value to these companies and to bring value, which is, we're not going to do something unless we can do that. But with that, it makes perfect sense for us.
Build on what Steve was talking about earlier about sort of private equity as a vehicle for former athletes versus being a spokesman. What is it about private equity that's attractive to you?
Well, I think for me, it's just the idea of acquiring and owning a company. And I've pitched many endorsements. I still do endorsements and have the idea of that you're pitching a product. This is a little bit different, that you actually have ownership in it, and you're trying to grow it, and you're trying to expand it, and you're using your connections in ways where you can make a difference and do something good. And I think that's the idea that we're trying to do. And I think sports are so popular with so many different people for different reasons, from whether you played it at a youth level or in college, and so there's so many different ways to invest around it. It's a business that's growing rapidly.
And so where does it go from here, Steve? How do you build this business up?
It has to be a good investment, or we don't have a firm, no matter how noble our intentions. Can we add value to the company? Is the price right? It's the same sort of questions we ask in our sort of private equity deals. We don't have to swing at a pitch, and we won't swing at a pitch doesn't mean we're always going to be right, but we won't swing unless we're very convinced that we're going to be
That
right.
was a baseball reference. I don't know.
Yeah, I figured it out.
You've got private equity, you've got the Manning cast, you've got endorsements. How do you sort of put it all together?
It's just time management and coming together, and so I enjoy this part of it, just learning this world, and it is very new, and every day I learn something new about it, and talking with Steve, and I feel like this last year, it's my freshman year of taking private equity 101 and getting to kind of get involved and ask a ton of questions. What interests you? What were red flags? Why is this going to work, not work? What do you like about it, don't? And for so long I was just doing football, and I was so focused on it. That's all I did, and still involved in the game, which I love, and getting to sit on my couch and watch football games and make fun of Peyton is exciting also, and you get to kind of view football in a different way, but also learning private equity and learning the business side and how businesses work and the culture around those businesses is all very interesting, and enjoy the learning process of it.
Eli's time management skills, I have to say, they're unbelievable. Yeah. We have our weekly calls on Wednesday at 11 o'clock, I think. And so Eli, before the call one of the weeks, he says, I'm not going to be able to talk to anybody during this call. I'm going to be completely quiet. So after the call, he sends us a text picture of him as Chad Powers. He was having the makeup put on during our call.
Wow. But I couldn't talk. I couldn't move my mouth. They're working around that area. So I was listening, but they asked a few questions. I was like, I can't move, I can't talk, I can't text, and I'll show you afterwards what's coming from this.
Massive Bills fan, obviously a Giants fan. Could we have an Eli versus Steve Super Bowl?
That would be exciting. I think we would both take that scenario. It would be worth the awkward week of the game, and unfortunately afterwards, that week after, we probably would not talk and just like, all right, let's have a cooling down. But I think that would be a win-win situation for the most part.
Because you've been talking up the Bills. You and I talked a couple months ago, and you were
the Bills are they're my like adopted AFC team. I think it's New York, it's AFC. The Giants and Bills don't play that often. We kind of have a good experience. The last time we met in a Super Bowl, you might want to forget that one. But,
there are two words I don't ever want to hear again: wide and right.
Yeah, there you go. All right, guys, thank you so much.
Thank you.
And thanks for tuning in on Bloomberg Surveillance today. Matt and I will be back tomorrow. This is Bloomberg.